Hello everybody, welcome to the virtual broadcast of the annual Momentum Global Investment Management Think-Tank Conference 2024. I'm here at our head office in Centurion, South Africa now, but a couple of weeks ago we hosted the in-person conference at our UK office in the heart of the City of London. While we were only able to accommodate a few dozen delegates there, I'm pleased to be able to welcome the nearly 2,000 people signed up for this virtual version over the course of today and the next 2 mornings. We're delighted to be able to engage with so many of our clients and partners from all over the world in this way every year. The timing of this year's conference could hardly have been better, kicking off on the day of the latest Federal Reserve interest rate decision, where they made the first cut in rates after over 2 years of sharp monetary tightening. We think this marks a critical turning point for the global economy and financial markets, which is discussed through several of the speaker presentations, along with our theme around the impact of developments in artificial intelligence as we live and invest through what may be the foothills of a fourth industrial revolution. In a moment, you'll hear from me at the introduction to the in-person event with an update on our business, as well as a preview of the conference and speaker lineup. As I explain, you'll see we have a mix of third-party speakers representing the specialist managers we invest through, as well as in-house speakers who outline how we incorporate the often divergent views and approaches that these partners have into our own processes and portfolios. We also explain the wider range of strategies we now have available to access these asset classes and strategies. We hope you enjoy the conference. It's never as good as being there in person, but I hope you'll agree it's not far off that experience. One of the advantages of the virtual version is the ability to engage widely on the platform throughout the sessions. Please do use the opportunity to ask any burning questions you have via the Q&A section, as our team are on hand to respond. You'll also get full CPD points for the sessions you attend. For viewers in South Africa, please add your ID number, and for UK viewers, please add your advisor firm FCA number to the CPD section. The system will automatically verify the time you watched. The virtual platform will remain open until the end of November if you'd still like to view any of the presentations you weren't able to see. After the webinar, all the videos will be available on our events page and the Global Matters portal on momentum.co.za, as well as on the Global Matters WhatsApp bot and our MGIM website, momentum.co.uk. Thank you very much for joining us today, and I hope you enjoy the first day of Virtual Think Tank 2024. Very warm welcome to Think Tank 2024. Most of you know me all too well already, but for those who don't, my name is Andrew Hardy and I'm the Managing Director here at Momentum Global Investment Management, or MGIM, as you know us. Several of you joined us for last year's event, so thank you very much for joining us again, and for newbies, welcome. Pete will forgive you for missing last year, given your phenomenal record over the last 21 years or so, I think, of attending. We've got a slightly different venue from last year, for those who did attend, so we were high up in the Shard back then, and we have a new format too. We hope that being in the office once again, together with a smaller audience, will make for a more engaging couple of days, and will thereby give you the chance to get to know our business, our team, and the partners we work with that much better. It'll also be a bit of a send-off for this office, as we'll be moving within the city in the next year or so. Fear not, we'll be somewhere with more reliable lifts than here for sure, although hopefully they hold out. Regarding the format, today will look very familiar for regular attendees, with a host of speakers from the range of partners and third-party specialist managers that we invest with across our portfolios. Tomorrow will be quite different from both today and from previous years, as our investment team will focus on piecing together the insights shared on day one, whilst sharing our own perspectives and an overview of how the various strategies are used across our portfolios. More on that shortly. Before I go there, a short recap on our business and some of the highlights of the past year. As a reminder, for those less familiar, or for those less familiar with us, MGIM was set up as the global investment arm of our South African parent company, a large insurance business, back in 1998. Our foundations were the internal group assets that we were tasked with managing, around which we built out a dedicated investment team and institutional grade process and controls. Wind forward to today, and those group assets have grown significantly, and off the back of that, we've developed solutions for other retail and institutional clients around the world, such that AUM today stands at over $8 billion, And then we have a well-established institutional consulting business in Windsor, which is responsible for advising on a further circa $20 billion or so of pension fund assets. We're very well resourced, with around 80 people in the UK and over 16,000 across the wider group, predominantly in South Africa, but operating across 9 countries in total. The group has a proud heritage going back some 126 years. I joined mere 19 years ago, and to my memory, we've always positioned our business to clients as something of a standalone boutique, but with the backing and resources of a very large group. A key change over the past year is that we've reimagined that structure and positioning and have moved towards creating a properly integrated global business that pools the resources globally across the UK and South Africa. The upshot of that is that what we do in the UK for global clients is much more actively supported by our colleagues in South Africa, several of which are here with us today, which will give us access to more expertise and resources than we've ever had before and should ultimately lead to better service and outcomes for your clients. Another smaller but notable change is that until recently our ultimate parent company, which includes all of the insurance operations beyond our investments focus unit, went by the name of Momentum Metropolitan Holdings. That's the listed entity in Johannesburg, or MMH. But we've now simplified that to Momentum Group. We still retain distinct and well-recognized client-facing brands below that, including Metropolitan, Iris, and Guardrisk. But from an investments point of view, we all show up as Momentum. These businesses are all bound by a common purpose to build and protect our clients' financial dreams. Expect to see and hear more from us on how we're living up to that in the near future. And the perfect example of us tying all of that together with those changes and imperatives is the launch of Curate Investments, which is a truly global initiative driven out of South Africa by my colleague Ray Miro, who's at the back there, who you'll hear more from on this tomorrow. How does this matter to you? It's a whole new range, built and executed very differently from our multi-asset, multi-manager solutions, which gives you a number of new levers you can pull to construct portfolios differently and hopefully better meet clients' needs. And a final update is around sustainability, where our approach and processes have developed quite significantly in the past few years to match clients' expectations and regulatory requirements, particularly for our dedicated sustainable products. And as a natural development, as so much more information and data is now available to support proper ESG integration. Our group has been a long-standing signatory to the United Nations Principles for Responsible Investment, or PRI, but I'm delighted to say that we are now also signatories to the Stewardship Code here in the UK. That's run by the Financial Reporting Council. It's the key standard for asset managers operating here, and they don't let you in lightly. This year's report was our 3rd submission in as many years. But beyond that achievement and status, which underscores the quality of our stewardship for investors, the report has a rich amount of information on our business, portfolios and processes, which I hope can be really useful for you and your clients. Given it's nearly 100 pages, we've not printed it, but you can access it via this QR code. Beyond just stewardship, I would emphasize that it provides a lot of useful information on our team, our processes, and some, bringing those to life. I think snippets of that can be very useful for client conversations. Now onto the conference itself. Our theme this year is investing through the 4th industrial revolution, reflecting the imperative for us all and the partners we work with to focus our minds on how advances in AI technology are rapidly reshaping the world we live in, the impact on markets and portfolios, and the opportunities and risks it creates. I'm sure I don't need to tell you how transformational the advances in AI have been, and while we can question and debate how technology and use cases develop going forward, we have to recognize their game-changing nature. If you don't get your head around how it impacts you and your clients and business, then I think you're really not doing your job properly and risk being left behind. Of course, the current AI boom started in late 2022 with the launch of ChatGPT from OpenAI and the first widely available generative AI. That started an arms race globally, and most visibly to us has led to a near unrelenting surge for AI-related stocks and the so-called Magnificent Seven cohort since then. To highlight just a few interesting stats around this theme, first of all, around the speed of adoption, ChatGPT on the right there got to 100 million users in just 2 months, which compares to 9 months for TikTok, 2.5 years for Instagram, etc., etc. I think it actually got to 1 million users in the space of just 5 days. Microsoft's offering Copilot has already reached over 400 million users last year and was increasing at a 60% quarter-on-quarter rate as of most recently. We're among those firms that have made Copilot available in the workplace. Secondly, profit creation. NVIDIA is currently valued at around $3 trillion. That's equivalent to the entire value of the UK stock market. So just in terms of how to read this, that's the weightings on the left-hand side of the individual stocks or the countries. So you see there, NVIDIA outpacing most of those, all of those large countries there. Recall it was only 6 years ago that Apple first broke through the $1 trillion mark. It was first to do that. However, interesting side note, such valuations are not entirely unprecedented in inflation-adjusted terms, although it's not encouraging to know that the last company to have as high a value in real terms as NVIDIA was the South Sea company back in the 1700s, which didn't end so well. Thirdly, the economic impact. According to a report by McKinsey, generative AI could contribute up to $4.5 trillion annually to the global economy by 2030. That's about 4% a year from current global GDP levels. This graphic displays the proportion of that which they expect to come from new Gen AI use cases on that kind of left-hand bubble, creating revenue opportunities and cost savings, together with a larger proportion that is expected to come from general productivity increases, that bigger light blue bubble. The IMF estimated that 60% of jobs in advanced economies will be impacted, and it's hard to see any industry being spared. While the hype and progress is most evident in the tech sector and digital businesses, it's arguably some of the lowest tech areas and older business models where the greatest opportunity and potential for change lies. The landscape for financial advisors will undoubtedly be among those areas disrupted to some extent. The question is how and to what extent. Of course, that's not even scratching the surface of this topic, but only time will tell whether we're truly in the foothills of a fourth industrial revolution rather than an extension of the third digital revolution, the mid to late 20th century. But there's enough evidence to suggest that we may well be. Our various speakers will expand on this topic in much more detail and share their unique perspectives and insights, which in most cases is from a valuable bottom-up, on-the-ground perspective, seeing the real-world changes across a range of geographies and sectors. There's a lot to consider and a huge amount of unknowns, but I hope you come away with more clarity than questions. You'll certainly come away with a much better understanding of some of the areas of AI that our portfolios and your clients are exposed to, and the investment process use cases. Beyond AI, there are a couple of other big events for us to tackle. Later today, we'll get the latest interest rate decision from the US Federal Reserve, which will almost certainly be the first cut for more than 4 years, from the current 23-year high of 5.25 to 5.5%. Markets are currently pricing a 70% chance that it's a double cut of 50 basis points, but there's an unusually high level of uncertainty on this, with the alternative being a single 25 basis points cut. Either way, this is a massive turning point, alongside the initial cuts we've seen from other major central banks recently, as the rate cycle turns and potentially drives a sea change in the market environment and patterns of asset class returns. Indeed, with around 8 cuts from the Fed priced in by markets for the next year alone, bonds have been delivering strong performance over the past 3 months. Broad fixed income indices have returned 5% or so over a period during which the so-called Magnificent Seven are down some 10% or so, and global equities are flat. Don't underestimate how significant a turning point this could prove to be, with the key uncertainty being around whether the Fed has left it too late to achieve a soft landing for the economy, as evidence of a slowdown in activity has started to appear lately. Plus, of course, we'll have the small matter of a US election just 7 weeks away. Our in-house economist, Sunish, is here somewhere, I think, will share her views on that and geopolitics more widely tomorrow morning. And I've no doubt Glyn will build on that further in his customary roundup at the end of the conference tomorrow. Further to that, I'd just like to run through the other speakers for the 2 days. In a moment, I'll hand it over to Ravi Balakrishnan from JP Morgan for a macroeconomic perspective. Over the course of today, you'll hear from 3 global equity managers, each of which we've now launched an individual fund for as part of that curate range that Ray Miro will outline in much more detail tomorrow. Those 3 managers will have very contrasting investment styles. The first you'll hear from before the coffee break this morning is Mark Baraboo on the left there from Jennison, who many of you will recall from previous think tanks. Mark and team focus on owning leading growth companies that are often disruptors and where earnings are accelerating. They've been big beneficiaries of the phenomenal performance of Nvidia and some of the other AI-related stocks and themes. That's driven strong outperformance from their strategy, which has been a significant and long-standing holding across many of our portfolios. Later in the day, you'll hear from James Nerdler and Christina Dyer from Evenlode, who have an approach that places greater focus on business quality, stability, and valuation, which opens the door to them owning slower growth businesses and often leads to a less volatile performance profile. It's 10 years since we first invested with a different Evenlode strategy, their UK income fund, which has delivered fantastic performance since then, around 9% annualized and ranking 5th out of over 180 funds in its sector over that time period. This global strategy has a shorter 4-year history, but builds on most of the same team and process. So we've high hopes for a similarly good client outcome over the next decade. Then completing the style spectrum, we'll have David Merklin from Lyrical, who have a very original and deliberate approach to value investing. And we'll talk about some of the mispriced opportunities they're seeing across less glamorous or less covered areas. I'm certain they'll share a highly contrasting view on the Magnificent Seven from the other managers. And tomorrow, my colleague Lorenzo Laposta will talk through how we resolve and capitalize on those divergent views and strategies in our equity portfolio construction. We'll also hear about the myriad opportunities available in the private equity and venture capital space later, much smaller and earlier stage businesses where the risks are much higher and deep due diligence and expertise is vital, but where the potential upside is vastly greater than for the majority of established listed businesses. This will be led by Ben Wilkinson of Molten Ventures, through which we get exposure to a portfolio of such opportunities via their London-listed company, thereby avoiding a liquidity mismatch for the liquid solutions that we offer. That structure means the price can diverge from the underlying net asset value of the portfolio, creating a premium or discount, which can create great opportunities at times. We recently introduced the company to many of our portfolios at what we believe is one of those opportune moments at a discount of approximately 40%. And to bring the asset class and opportunity to life more fully and closing out today, Ben will be followed by Mike Walters, the CEO of Form 3, one of their portfolio holdings, who provide banks and regulated fintechs with an end-to-end managed payments service that aims to disrupt the legacy banking architecture and incumbents. Also, while fixed income asset classes have held little appeal over the last couple of years through a sharp rate tightening cycle, the next couple of years will look very different, and it's important to position for that now. We'll be joined by Luca Evangelisti from Jupiter to talk about quite a niche part of fixed income, financial bonds, and more specifically contingent convertibles or COCOs and AT1s, but one which we think is particularly compelling and lives in many of our portfolios since recently. And the final two third-party speakers will focus more on the use cases of AI and new technologies within investment processes. Robeco's Mike Chen, representing our quant equity investment manager of choice and used across several mandates, including 2 of the Curate strategies, speaking later today. And Tommaso Migliore from M.M tomorrow. You may recall him from last year as well, some of you. M.M provide us with access to their machine learning asset allocation model, which we recently began to integrate into the portfolio construction process for some of our solutions. Then across various sessions tomorrow, our investment team will present on how we use the insights from these various specialists and their strategies within our process and portfolios, as well as on some of the dedicated funds we now have available to broaden the toolkit you can access for your clients, as well as risk profile multi-asset strategies, which we've often focused on in the past. That includes our multi-manager equity fund and an alternative strategy focused on real and private assets, such as those venture capital speakers that are closing out today, and that new Curate range of single manager equity funds. I hope you'll leave day 2 with a complete understanding of our outlook on the investment landscape and where we think the key opportunities and risks lie, as well as a full picture of the strategies available to you. I think it's another outstanding lineup. I'm biased, but I think it is, which I'm very grateful to all of our partners and team members for participating and sharing their insights. And thank you for sparing your time to be here. I'm well aware that there are plenty of conferences to choose from, so thank you for giving up your 2 days or more for those travelling, in many cases from further afield. I hope you find it a valuable couple of days that supports your business and enriches your client conversations. We will allow time for questions at the end of each presentation. Please don't let the speakers get off lightly. So now, without further ado, I'll hand over to our first speaker of the day. I'm pleased to welcome Ravi Balakrishnan, who is Chief European Economist for JP Morgan. He has a hugely impressive CV, having spent over 20 years at the IMF with various postings around the world, including Washington, Peru, Bolivia, Sri Lanka, and Singapore. He'll provide a global macroeconomic overview entitled Narrow Path to a Soft Landing, and hopefully will share his view on whether he thinks it's a path that can be successfully navigated or not. Ravi, over to you.
Thank you, everybody. Pleasure to be here. Hopefully we can have this will stimulate you a little bit, and we'll see what kind of questions we get at the end. I'll make sure there's enough time for that, given the, as Andrew was saying, it's a consequential day today with the Fed making its decision on whether to cut 50 or 25 basis points to start off the interest rate cutting cycle. So as Andrew mentioned, this is really about, I'm going to give you a helicopter view of how we see the global economy, focus on the US, China, Western Europe in particular. And a key question really is, are we going to get a soft landing or not? I think that's where I'll start off. Since the pandemic and the war, there's been a lot going on. We use the word unprecedented very often, but they are unique shocks in a way, or rare shocks. And so you've also got structural changes going on at the same time, demographics going in reverse in Western countries, the various transitions that we talked about that Andrew mentioned. So there's a lot going on. And so within that, you've got cyclical developments, structural developments. It's hard to think of a very clear baseline with a really strong degree of conviction. So we've been running with various scenarios, probably since early 23, and you can probably broadly split them into two camps. Soft landing, and I'll go into different scenarios for that, and then boiling the frog, which is really your harder landing, a recession scenario. So we've changed the probabilities. They've moved up and down, so I wouldn't put too much weight on the specific numbers, but broadly speaking, we've been moving up our soft landing probability, so it's now around 55% over time. The boiling the frog has been a little bit below 50s, moved up and down. I mean, I think in 23 there was a lot of concern about recession risk in the United States. They started to come back again a little bit. So because they've started to come back, a lot of it's focused about the US outlook and how it spills over to the rest of the world. Our recession probabilities now for the second half of 25, second half of 24, have gone up from 25% to 35%. So it's a slight increase. It's still obviously the soft landing is the modal scenario, but we do think there's a bit more risk associated with labor market developments, particularly in the United States. But overall, our probability of recession by the end of 25 hasn't really changed. It's still around 45, just below 50%. So I mean, it's still quite a lot of time to end of 25. And in normal times, there is still usually a reasonable probability of recession priced into markets. But ultimately, we've changed our near-term risk bias in terms of a slightly higher probability of recession, but not a recession by the end of 25. So within these scenarios of soft landing, you've got the immaculate disinflation, which is your really rosy scenario where rates are cut pretty rapidly in the US, in Western Europe. You get inflation down to 2 by middle of next year on a sustainable basis, and you don't get much of a correction in terms of growth. So growth remains reasonably strong. The other scenario is a little bit reflecting that maybe potential growth has gone up. You've got all these big investment needs. So the real interest rate, the neutral rate, may have risen. So you can still get reasonable growth, inflation coming down, but the interest rates will be a little bit higher for longer. They won't come down as quickly as in the immaculate disinflation scenario. But growth is still reasonably strong and maybe at trend or above trend. Then the boiling the frog scenarios, there's the wait for it, which is similar to the high for long of a soft landing, but interest rates stay high for a little bit longer. So you may get some cuts. You may get a little bit of a long period where rates do not change. And that eventually leads to margin compression of corporates. You start to see adjustment in the labor market, employment destruction. You get your typical recession dynamics as consumption starts to tank. Now, the other scenario, which is, we would say, less probability is attached to it now, is a too darn hot scenario. This was getting a bit of play a couple of months ago when we saw consistent prints of high core CPI in the US, and there's this concern about whether that's going to flag core PC also rising. So at that point, people were worried that maybe the Fed is going to have to hike again. I think those kind of concerns have come off quite significantly, so I wouldn't put too much weight on that scenario. It's not totally ruled out, but it's a low probability scenario. So that's basically how we see the global outlook. So in some senses, both scenarios are still in play. There's a little bit of observational equivalence about the data that we see, and it could be consistent with both of those scenarios, although overall, we do see a high probability of a soft landing, with some concerns about the labor markets, in particular in the United States. So let's turn to the US. So the US really has been doing extremely well. We've had much higher than 2% growth over the last year or so. It's starting to decelerate, but in some ways, the key question is how quickly will it decelerate? Will it eventually stall or not? Currently, the tracking for Q3 looks pretty good. Our forecast is 1.5 for Q3, but the tracking is actually higher than that. I think the Atlanta Fed nowcaster is at 2.5. So, I mean, overall, retail sales was also strong. So developments in the US in terms of overall activity look good. And you had very strong consumption, which I'll come on to in a second, but you've had overall strong domestic demand. Fixed investments been doing generally pretty well. Structures was going up significantly in 23. The growth rates come off a little bit since then. There was a big impetus from the public sector, particularly in 23. We had a deficit of 8%. There's very strong government consumption. Some of that stimulus is starting to come off, although there's still a little bit of uncertainty about how state and locals will spend going forward. Now, one big difference when you compare to Europe really has been the US consumer. They've been spending. They've been spending actually above their real income gains, and so their savings rate has been coming down, which is what you see, if you can see it, in the upper right-hand chart. So that's a big difference when you compare to Europe. Now, one important driver of that is not just the real disposable income gains, but also that wealth has actually gone up. Financial assets valuations have gone up. Housing wealth is still high. I mean, prices really haven't corrected much, even though housing investment's gone down. So overall, when wealth is higher as a percent of income, then typically you can afford to save less. The other key thing is that despite the interest rate rises, as you see in the lower left-hand chart, the actual debt servicing ratios really haven't moved up that much, relatively speaking. So they've moved up, but if you compare to, say, the GFC or in the 80s, the debt service ratios are much lower because the degree of fixation in particularly for consumers is very high. A lot of people have 30-year mortgages. The share of 30-year mortgages went up significantly before the pandemic because interest rates were so low. So the refinancing wall, at least for consumers, you don't really see that hitting. What you do see is very low housing activity because people can't afford to refinance their mortgage right now. So they're waiting as a wait-and-see approach. Now, as I was alluding to a little bit earlier, one concern is really about the US labor market and where it is. We had very strong payroll growth up until quite recently. You can see that in the upper hand side chart, US private payroll growth has started to decelerate quite rapidly. And there's been some revisions, and if you take those into account, it does look like you're getting close to potentially what's called the stall speed for the United States, which is US employment growth averaged over 6 months below 1%. That typically has been a signal of, often it's difficult to predict whether you can stay at that level or whether you're going to decelerate very rapidly. So I think that's the point of where we're at now and where people's concerns are. And if you look at hiring and firing rates, they've both been coming down quite considerably over the last year or so. So you're seeing it's certainly a significant normalization in the US labor market. The question is, will it go further or not? And so related to that, there's been a lot of discussion of the SAM rule. Claudia Sam is an economist who's written about triggers for recessions, and her rule is that if the 3-month average of the unemployment rate is 0.5 percentage points above the low in the previous 12 months, then that's a sign that an recession will be on the way. And it's often been a fairly good predictor, if you look at the table, of previous recessions, although she herself has not dismissed the signal this time around, but made clear that it's not, you got to take into account the fact that some of the increase in the unemployment rate in the United States has been driven by increases in participation, increases in the labor force. There's been significant migration, as we all know. Undocumented migration has been a big part of the increase in the working age population in the United States over the last year or so. And that's created this increase in the labor force that we've seen. So, and that's part of the reason behind the unemployment increase. So far, we've not seen a significant increase in layoffs, which is what people are focusing on in terms of whether the labor market is really turning or not. So, some concern about the US labor market. Key question, will it just simply stay at this, it's just a mid-cycle slowdown, or will it eventually go into recession? Now, one obvious real wild card is the US election, and what it can mean. That's going to be incredibly consequential. As we see it right now, it's a toss-up. It's going to come down to the same swing states as always, the 7 swing states. I mean, there's a lot of focus on Pennsylvania right now in particular. So it's hard to predict. But what we can do is at least think about scenarios of whether there's a Trump victory or a Harris victory. And it can make a big difference also to whether if Trump does win, whether he gets a clean sweep, i.e. control of the House or not. It looks like Senate, it could well flip to the Republicans. Control of Congress may depend a little bit more on who wins. In particular, there seems to be a path for Trump, if he does win, to get control of Congress as well. So if there's divided government and Trump does come in, there's still significant actions he can take by executive orders, including tariffs, including on migration, and including on regulation, deregulating further oil and gas exploration, for example. So one big concern is obviously tariffs coming in. It's pretty clear if he does come in, there will be some escalation of tariffs and increases. There will be negotiations, clearly. So we don't know whether the numbers people have talked about now will actually manifest themselves, i.e. a 10% tax on all goods imports to the United States and a 60% tariff on Chinese imports of goods. Now, this can make a difference because in the previous trade war that we saw, there was a significant slowdown in activity globally. And we see this, if you can, in the lower left-hand side chart. The orange line gives you manufacturing future output, which went down quite considerably, and also the oil industry output went down quite considerably around the time of the trade war. So trade policy uncertainty did lead to a deceleration in activity. So this trade wars can and will have an impact on overall activity. And if you dial up these tariffs, I mean, the previous tariff wave in 2018, 2019 was about 1.8% of imports as a share of GDP for the United States. So the total cost as a share of GDP was around 0.4%. Now, if you add up the other elements he's talked about, 10% tax on global goods, 60% on China, that's going to increase that amount by 1.4 additional percentage points. So it's going to be about 1.8% of GDP. So that's not a small number. So it can have an impact on overall consumer incomes on activity. I think that most people are more concerned about the inflation side for the US and activity in areas like the Euro area, which is more closely aligned with the overall global manufacturing cycle. So for Europe, a little bit more concern on the output side. In the US, a little bit more concern on the inflation side of the impact of tariffs. Now, immigration, obviously, if you do put the brakes on immigration in a very abrupt way, that will have a significant impact on overall activity. We've seen a big boost to activity in the US related to this, so that will definitely have an impact both on inflation and output in the United States. On the regulatory side, further deregulation of oil and gas exploration, that will have an impact. But it's also true that the US has been producing at record levels consistently for a while, so the delta on that may not be felt for quite a while. Even Biden, when he froze further consideration of new LNG potential sites, it does make a difference through the end of the decade because you've already got a lot of LNG coming in over the next 5 years or so. So it's more about the next decade, I would say. Now, the other thing which is important is really what happens on the fiscal side. So what happens on the fiscal side, whether they can renew some of the provisions in the TGCA of 2017, in particular some of the income tax cuts, depends on having control of Congress. But you need a new act, otherwise they will sunset. Now, both parties do not want to have an abrupt adjustment. Trump obviously will probably, as mentioned, various other taxes that he wants to cut and using the tariffs as the other source of revenue. But will it make a big difference to the US fiscal? It's unlikely to lead to further US fiscal expansion. What it will do is mitigate the degree of contraction which will come in if the TGCA naturally sunsets. So it's not necessarily going to lead to a worse US fiscal situation, but it won't necessarily lead to a much better one. Okay, let's quickly talk about China. So China is really going through difficult times. Domestic demand has been weak. They've been exporting deflation, which has helped actually disinflation in many countries, particularly on the goods side. And you've got if you look at the right-hand side chart, you see really a big divide between public fixed investment and real estate investment, which are on two different trajectories. So public investment has been holding up overall investment in China. Private fixed investment has been largely flat, and obviously there's been a significant correction still ongoing in real estate in China. So near term, we still expect growth to be close to 5%, a little bit below the government's target this year. Although obviously, if that's really under risk, it's quite likely that the Chinese government will take more measures through the rest of this year. Now, what about the longer term picture for China? Well, the longer term picture is that growth has been decelerating from extremely high levels. Some of this is driven by demographic changes, which is the right-hand side chart. The growth of new workers is going into negative territory. China is aging before it becomes rich. Unemployment for youth is high. And in particular, I'll draw your attention to the lower right-hand side chart, which is about China's potential growth. This has come off quite considerably. I mean, our estimates are now that it's going to be between 3 to 4% going forward. So labor will actually be a drag now because of the aging process and the decline in workers. And one big change has really been the revision in TFP, partly because of the clampdown on tech, partly because of the geo-economic tensions as well. So overall, China's prospects in terms of driving the global economy clearly it's not going to be as much of a delta as it was in previous decades. Now, what about Western Europe? There's been a lot of focus on Western Europe this week, and particularly the EU. The Draghi report on competitiveness in the EU came out last week, still making a big splash. And related to this is really about the question, is Europe being left behind? And cyclically, it's clearly the case that there's been a much stronger recovery in the United States. We see this very clearly in the left-hand side chart, which is the overall level of output relative to the pre-pandemic trend. The US is the only zone where it's above zero. What's been driving this on the production side is labor productivity, which is the right-hand side chart. You see that US labor productivity has been extremely strong cyclically, whereas in Western Europe, it's been extremely weak. We've had negative productivity growth for quite a while. It just turned positive in the euro area in Q2. And as you can see over the longer term horizon, you've had divergence in productivity between the US and the euro area. And you've also had much higher levels of investment in the US relative to the EU. We exclude Ireland because Ireland really does mess up the statistics and the comparisons. So the Draghi report and some other reports, the Letter report, which came out earlier this year, they've been very much focused on how can you drive growth in the EU. And it's hard. And there's various areas. Tech is one area. Tech investments have been a lot lower. Draghi mentioned that tech is one of the big differences in terms of productivity between the EU and the United States. So there's focus on that. There's focus on trying to leverage more private capital via trying to give a big push to capital markets union. And there's also consideration of how to confront the challenges of the IRA and the CHIPS Act in the US and China's subsidies to its industries because it's more fragmented in Europe. So how do you try to combine industrial policy with their existing state aid policy, which tries to keep the integrity of the single market by creating a level playing field. So these are really hard discussions and will be the focus of the Commission and the current, the new Parliament over the next 5 years. But there are big challenges. Within Western Europe, the euro area is a big contrast to the United States in that consumers haven't stepped up. Consumption has been very weak. And you can see this in the upper left-hand side chart that real spending, the blue line, is below real disposable income growth, which has turned significantly positive. People are still saving. There's a degree of precaution in people's activities, partly, and you can explain it. You've got war on the doorstep. You've had a massive terms of trade shock. Energy prices have come down, but they're still high. Retail prices for energy is still high. Mortgages will eventually reset. So, degree of fixation has also increased in Europe, but it's still quite low. So people are preparing for these events. So there's still a significant degree of caution in behavior. Consumer confidence, which is in the lower right-hand side chart, the blue line, has been increasing as inflation has come down, but it's still significantly below historical levels. So confidence is still weak on the consumer side, and you've got weak consumption dynamics, and that has to change if European growth is going to pick up and maybe maintain a rhythm of around 1% or potentially above. Another issue which we look at is monetary transmission starting to fade. President Lagarde mentioned this also in a press conference last week. The delta of the high interest rates is starting to fade. And we can see this in that bank lending, although it's still, growth rates are very low, upper left-hand side chart, is starting to turn. Lending standards are also not tightening anymore. So it looks like the credit cycle is going to start to turn very soon in Europe. Labor markets is the flip side of productivity. Weak productivity has meant that you've had extremely strong employment growth in the euro area. This is one big contrast for the US. In the US, unemployment started to pick up. In the euro, it's still a historical low of 6.5%. So the labor market has been one beacon of light, in a way, in the euro area. Significant increases in labor force participation, tremendous employment growth, but it is a flip of very weak productivity performance. So in terms of inflation, you've had significant disinflation in the euro area, even despite these tight labor markets, as energy and food price inflation has come off quite considerably. So you still have this issue, which you have in many zones, of the difference between, which is the upper right-hand side chart, the difference between core goods inflation and core services inflation. So services is still sticky, and this is going to be the focus of the ECB in the next year or so. So we still expect further cuts from the ECB. We have our next cut priced in for December. And then we have steady interest rate cuts every meeting next year. So it's a more gradual path than for the United States. For the United States, I should have mentioned this earlier, we did change our call recently. So now we have, our call is that the Fed will cut by 50 basis points today. Although it's a judgment call, it's still, you can see the arguments for 25. And then they will cut by 50 basis points the next meeting, and then 25. So around 125 basis points of cuts to this year, potentially only 100, but within that ballpark. So our view is on the US that the focus is more on the labor risks that I mentioned. And so you're less worried about inflation risks, labor costs are low, core CPI has come down. The balance of risks has changed. So you're focusing on the other mandate more than the inflation mandate. You're focusing on the full employment mandate. So if you're doing that, that means you should get to neutral as quickly as you can. And so that's the argument for doing these rapid rate cuts. The argument against it is that, it may spook markets and people that cutting 50 basis points, is that a sign that things are really going wrong? So I think the communication part of it is still a challenge, but you can communicate that you need to get to a neutral stance quickly, and this is why you're doing it. So I think it'll be interesting to see what the Fed does today and how they communicate it. So as in elsewhere, the last mile of the disinflation, as we call it, is the hard part. How can you get sustainably down to 2? And a large part of it will be related to wage growth. Wage growth has started to come off, but it's still at a high level when you take into account that productivity is very weak. So unit labor costs are still growing rapidly in Europe. So we have various wage models that we use, but in particular, German wage negotiations are tracked very closely, which is the upper right-hand side chart. But as you can see from the upper left-hand side chart, compensation per employee, the key employment variable, the most all-encompassing wage growth variable, has started to come down. It did actually come down a little bit below what the ECB expected in the second quarter. Although a lot of volatility is created by German pay settlements and one-off pay agreements for inflation compensation. So those are really muddying the waters a little bit. But ultimately, wage inflation is still higher than in the comfort zone. But the expectation is that it will come off going forward. Now, in terms of other things which could cause problems, CRE has been a topic of conversation, particularly in the United States, as its impact on the banking sector. We don't think it'll have a big impact in the euro area. There are similar problems of property valuations coming down in office space, for example, in particular, and CRE in general. But the overall exposure of euro area banks to CRE is significantly less than in the United States. If you look at the upper right-hand side chart, you'll see that it's around 10% for most countries in terms of their bank exposures to CRE. In the US, it's much higher, which is in the table. It's around 25% CRE percent of loans. So it's much higher. And if you can look at smaller banks, it's close to 50%. The exposure of US banks to CRE is much higher than in Europe. So we have less concerns about CRE exposures in the euro area, although you will obviously like to get some stress and some non-performing loans, etc. But ultimately, you've got to remember that European banks are highly profitable right now. And the reason is the lower left-hand side chart. You'll see that net interest income has gone up dramatically, and it's just related to the higher interest rate environment that we're in. The interest margin has gone up. The deposit beta is quite low. So the net interest margin is basically driving net interest income growth in euro area banks, although that is expected to turn as we go forward, but still remain reasonably strong. So banks in Europe, in the euro area, look particularly healthy. You've had a significant decline in non-performing loans, which is the lower left-hand side chart, particularly in countries like Italy, for example. Common equity Tier 1 ratios are very healthy levels. There's significant buffers that most banks have. Liquidity coverage ratios are also high. So overall, it doesn't look like any major stress in euro area banks. You need a massive shock really to cause them stress. Fiscal is important. People are focusing on the fiscal situation in Europe. I'm not going to go through this. It's quite a detailed table. I think the bottom line is there's some new EU fiscal rules coming in, and you will likely get consolidation going forward in Europe. We don't think it's going to be dramatic. We think that maybe the fiscal impulse will be negative by about 0.5% of GDP in the coming years. So it will be a little bit of a drag, but it's not going to be a dramatic one. It should be offset by private demand picking up if consumption does pick up as we expect. So overall for the euro area, we have a similar soft landing scenario. We have GDP gradually picking up. So we have our estimate of potential around 1. So it's not a really strong pickup, but it is going towards trend. We have the unemployment rate flatlining, basically. And we have headline inflation and core inflation gradually normalizing to around 2% by the middle of 2025. So it is a fairly immaculate disinflation. You're not getting a significant growth loss. And I think the difference, say, with the US is the growth has been much stronger in the US. So it's decelerating from a higher level. In the euro area, it was pretty weak in 2023. And it's been gradually picking up a little bit, although there's still some concerns about weakness going forward. The difference is the labor market, which is the flip of the weak productivity, has been stronger. So we haven't seen any tick up yet in the unemployment rate. So that's really where the labor weakness argument isn't as strong as in the euro area as it is in the United States. Elections have been a big focus. Obviously, we talked about the US election. There's been EU elections as well. Really didn't really move the needle, I don't think. And so the Draghi report, we'll see. A lot of the measures is a real call for action. The question is, will that action happen, given the institutional structure and the difficulty of some of these reforms? So the political right did increase its vote in the June parliamentary elections, but probably a little bit less than people expected going into the elections. So the von der Leyen's party, the EPP, actually did better than it did in 2019, which was a little bit unexpected. So there was a rise in the vote for the right-wing parties, ECR and ID, but not as great as people expected. And there was already a decreased focus on the green agenda and more on competitiveness before the elections, as it was quite clear what the result would look like and what the changing priorities are. There's a lot of concern about the costs of the green transition that a lot of consumers are facing in Europe, and so there's been a little bit of a pivot. There is a big focus on leveraging private capital and enhancing capital markets. Given the fiscal situation I discussed, a lot of the investments needs that Draghi talked about, 750 to 800 billion through 2030, increasing the investment share by 5% of GDP, are going to have to come from the private side. And you need a more efficient capital markets union to do that. Making progress on it is going to be very hard. It's a slow process, so we'll see where that goes. But it's right to focus on those elements. France, we still have to see what the government Barnier can form, and there could be some volatility associated with that. We'll have to see how stable that government is. And in general, we think that more consequential for Europe will be the US elections versus the EU elections. So I think it's very important what happens in November. Very quickly, let's just talk about the UK since we are here. So the UK growth looks a little bit better than in the euro area. It's picking up. There's been a bit more momentum. The July GDP data was a bit of a pothole, but it could be just due to volatility. But overall, you're seeing, we've revised up our recent GDP forecast. Business confidence, which is a lower chart, the blue line has been strong for quite a while. Consumer confidence is also starting to pick up, although it's still below zero in terms of balance. But the underlying picture is a little bit worse than elsewhere, though it's been changing quite dramatically. The forward-looking indicators of inflation in the UK are getting better, but services inflation is still very high, and the data today confirmed that, came in line with their expectations. But services inflation is still running above 5%. Core inflation is still running above 3%. So there's still the last mile still needs to be, there's still a last mile of the journey to go. A big part of what's driving service inflation in the lower right-hand side chart is really wage inflation. There's a very strong correlation between services and wage inflation. Now, supply side issues in the UK, big focus on this as elsewhere. Brexit had a big impact on investment, and you can see that clearly from this chart. The left-hand side chart tanked after the Brexit vote. But the labour productivity story predates Brexit. It goes back to the GFC, which is the right-hand side chart. Essentially, labour productivity has been on a much shallower slope since the GFC. So there's more than Brexit that is causing the structural problems in the United Kingdom. So boosting trend growth will not be easy. The government's right to focus on this, but it's going to be a challenge. As you can see, the OBR has been revising down its labour productivity path consistently. We are more pessimistic than the OBR about UK potential growth. The OBR has it at 1.6. We have it at 1 or below right now. So there's a bit of a gap there. And ultimately, a lot of the productivity trends will be driven by global developments. You do see a big spillover historically, which is in the table, between the US to the UK. So when the US does better, the spillovers to other zones. That also applies to the euro area. So if you do get a significant uptake of the AI revolution in the United States, that should spill over and have some gains for other zones as well. Now, in terms of the fiscal, the budget's coming up in October. We do expect to see a similar profile to what you've seen before. There will be a tightening. That was already in train before. We think the tightening on the fiscal side will be about 0.6% of GDP next year. This is a typical pattern you see after elections. You get a tightening first, and then maybe some measures taken further out in the political business cycle. So we expect that to continue. Obviously, there's some discussion about what measures the government will take, whether they change the debt rule, but overall, we do still expect a tightening over the next year or so. So the outlook for the UK, it is getting a bit better. As I said, we've been revising up our growth forecast a little bit, certainly through 24. We do still have a deceleration in 25, given the high interest rates and the lags in monetary policy transmission, although I'd say there's probably some upside risk to that. CPI gradually comes down. Inflation not quite the same pace as in the euro area. So we have a more gradual pace of cuts of the policy rate. The next cut we expect to be in November, not this Thursday, but it could depend on what the Fed does, obviously, today. And then we have a gradual sequence of cuts by 25 basis points per quarter. So you get down to 3.75 by the end of 25, which is higher than our current expectations for the euro area or the US. So I will stop there and take any questions that you have.
Thanks for the info. I just wanted to ask, do you not see the inflationary factors that the markets have been worried about keeping the Fed in line with a single cut? Or do you think those have dissipated and they've got room to cut as they need to?
Well, I think there's two parts to it. I think markets have moved, actually. As Andrew was saying, they're 70% pricing in 50 bips, and this moved dramatically late last week. I mean, the inflation part of the picture looks a little bit more reassuring in the US. As I was mentioning, core CPIs come down. Momentum-wise, three month, as we look at the more near-term dynamics, looks good. It's come closer to 2. On a year-ago basis, it's still around 3. So that is a little bit of a concern. There's still a little bit more to go. I guess the bigger concern is that if you do start cutting rates rapidly, will that, if you just get a mid-cycle, you still continue the mid-cycle expansion, that may keep inflation pressure reasonably high. So it may be harder to get down to 2%. So you can imagine a situation where they make a few cuts, and then they have to keep interest rates still in restricted territory for a while longer. So, I think, yeah, I mean, it's we had that, too darn hot scenario. We put less weight on that now. You can't rule it out, but it does seem a low probability event, given that you're still in highly restricted territory. So even if they do cut rates by 50 bips today, they'll still be restrictive. So you wouldn't necessarily need to increase rates to keep them restrictive.
Thanks. Good morning. Hello. I have a question. In your analysis and your forecasting, how do you actually build in a factor for potential escalation of the war in Ukraine, and how that would affect inflation going forwards? Because surely that could be a major factor in the next 12 to 18 months.
I mean, there's various scenarios you can think about for the war in Ukraine, right? A lot of it, some of it will potentially depend on what happens in the US election. I think Europe is preparing for maybe having to step in a bit more and providing more aid, both military and budget support, if the US does have a change of government and their appetite for continuing support to Ukraine decreases. But overall, if you look at it in terms of commodity prices, I mean, commodity prices have come off considerably during the war, right? Oil prices are now a little bit lower than before. Gas prices have been going up recently, but they're way above the 2022 peaks when it was close to 200 per megawatt hour. Now it's around 40 or so. So there's other factors which drive commodity prices. It's global demand. It's also what's happening on the supply side. For example, there's much greater production coming on the gas side from the US and also Qatar. So it's not a clear no-brainer what will happen with commodity prices. Now, in terms of your broader question, what could be the impact on Europe? Obviously, it depends on what you get. Whether you get an escalation, you just get a similar situation to what you have now and it dragging on, or you get some kind of agreement to have a ceasefire. So all those scenarios are still possible. I think the bar for reaching agreement is quite high because, Ukraine and Russia need to align in their objectives. And that's still a little bit apart. I mean, Ukraine will certainly want guarantees of its sovereign integrity of its borders. And the question is, how would you provide that, no matter what the change in the borders actually is eventually? But no, it's there's a lot of wild cards still. What happens there? What happens in the Middle East? What happens in the US election?
At the risk of exposing my ignorance, up to fairly recently, an inverted yield curve was seen as an indicator for a recession. And the SAM rule is not featured as much in sort of the last decade. Is it just not that our previous indicator is not working and we found a new one?
It's an interesting question. I still think there is actually a lot of value in the term spread, which is what you're referring to, right? The difference between typically you can do it, 2 year to 10 or 3 months to 10. So I think there's still value in that, but it's not a perfect indicator. I think you got to understand the mechanics of what's driving that term spread. Is it that interest rates have just gone up significantly at the short end, or is it more that you're worried about a recession further out, so your longer term rates have come down? So you've got to look at what the drivers of the inversion is. Similar for the SAM rule, you've got to see what's driving that unemployment rate to go up. Is it job destruction, which is more concerning than an increase in participation? So I think it's good to look at these signals because they have got some predictive property, but they always come with caveats. So you cannot follow them slavishly.
We're up on time, so we'll wrap up there. But thank you very much, Ravi.
Next up, as you can see, is Mark Bowden, Head of Global Equity at Jennison. He has been a long-term manager in our Global Equity Fund and is now running the recently launched Curate Global Growth Fund. As Mark would say, I'm almost sure, over the long run, you are your record. Since we appointed Mark and team coming up to 13 years ago, their strategy has outperformed the global equity market. Remember that thing that no one beats? They've outperformed that by 5.1% per annum and the global growth index by 3.3% per annum. Not bad. Ladies and gentlemen, Mark Bowden.
I know today we're going to cover a few topics, but the focus of it would be on AI just because of the structure of your think tank this year in terms of looking at this big structural shifts going on. There's a lot going on in our portfolio. We should cover that, do a quick review, but I'm going to spend most of the time talking about what's happening with AI. Sorry, you have a technical difficulty. Is that better?
You can use all the JP Morgan disclosures for us too, so I can skip that. So we're going to talk about the fourth era of computing, but before we do that, just some quick, background on what's happening on the markets this year and in our portfolio, because it is very, very concentrated out there in terms of where performance is coming from. Year to date, leadership really hasn't changed that much in global markets. It's evolving now as we speak in the third quarter, kind of going into the fall. You are seeing a little bit of shift, but basically it's been dominated by the Magnificent Seven. They've accounted for 31% of the global stock market return this year. That's actually down from almost half last year. So it is dwindling in impact, but it's still huge. For us, it's 63% of our outperformance this year is due to this cluster of companies. And importantly, NVIDIA accounts for 1/5 of the entire market return this year globally. And for us, it's about half of the alpha. So it's a significant contributor. And so we're going to talk about what's going on in the financial markets as it relates to this boom in generative AI, because it is really important. As a backdrop in our portfolio, we do have several areas of focus. We have this infrastructure build out for generative AI. That's probably the most important driver of return this year. But it's going to have second derivative impacts as we go forward. We'll talk about that. Secondly, we still have a big focus on these strong consumer brands globally that have direct-to-consumer distribution models. That means they control the inventory, they control the final sale to the customer, and so they can control margins, pricing, and general product evolution and dynamism. That kind of competitive advantage in today's global marketplace is really necessary to significantly outperform. So we're definitely still focusing on those types of consumer models, and that could be everything from Ferrari as a product to Mercado Libre as a e-commerce platform in Latin America. Thirdly, we're getting this industrial automation boom. A lot of it focused in the United States, ironically. It's not a global phenomenon, but it's being driven by the move to electrification, data center build-outs for AI, in general, electrification related to EVs, and of course the U.S. CHIPS Act, which is stimulating manufacturing for semiconductors in the United States as part of this big move to reshore supply chains away from Asia. So there's investment opportunity here. It's pretty narrow. It's all leading edge, but it is part of the portfolio strategy. Then you have healthcare innovation and treatment for diabetes and obesity. I mean, this is the biggest drug cycles of all time. We're talking tens and tens of billions of dollars of revenue going to two companies, Novo Nordisk and Eli Lilly. And so it's quite an enormous draw of consumer dollars going into these drugs. So we're taking advantage of that also in other areas of rare diseases. And then emerging markets platforms, technology and internet platforms for financial services and e-commerce. Those continue to do exceptionally well, particularly in Latin America, where you're getting a boom in fintech revolution. You know, you're absolutely democratizing access to financial services at low fee to millions and millions of customers, and they're flocking to these platforms. It's pretty exciting. And then lastly, one of the new additions to the portfolio in terms of where we're tilting, the Fed is on the verge of cutting rates by any minute now, and we're going to start an easing cycle. Long-term interest rates have already come down in anticipation of this. We're going to see more interest rate reductions over the next 6 to 12 months. That's going to help the one part of the economy in the U.S. that's structurally has massive pent-up demand, and that's housing. The millennials are hit their peak household formation years. They're bigger than the baby boom, and there's no housing. And so it's going to trigger, we think, a multi-year build of units in the U.S. It's going to lead to a dramatically enhanced or increased mortgage availability and demand. And so we're taking advantage of that in the portfolio because we think it's going to be a structural winner for the next few years. So that's sort of an overall overarching nature of our portfolio where we're focused today. But as we said, we're going to focus more on Gen AI for this audience today, as just like what's going on. This is it's a big land grab. It's a gold rush. Anything you want to call it. There's hundreds of billions of dollars being bet on this, and so we have to get it right if we're going to be successful. It has enormous impact on everything we do in life. But it's going to happen one step at a time. And the first step is sort of here on the left side of the page is just the build out on the compute power. So when we think about Gen AI, why is it interesting? It actually creates its own new content, new video, new software code. It's thinking like a human mind. It's not like machine learning or traditional AI, which was very linear, very instructive, with constraints on that construction. So you're actually in a phase of content creation, which is very powerful. It's also going to start to take away market share in traditional search, internet search, like Google search, as you use things like ChatGPT to do information search that's different, less structured, and more creative. And so this is a giant transformation in technology, and the infrastructure out there isn't ready for it. So when you see what's happened so far, we've already had billions of dollars spent. So the spending is accelerating. It's just the beginning. And then we expect sort of this end user, the application software, the end user, that's where we expect to see the next iterative product and service sweep for the next 3 to 5 years that's going to be really important from an investment perspective to be on top of. So let's go through the pieces. First, ChatGPT took 2 months to get to 100 million users. That's one of the fastest, if not the fastest, application in history. Took TikTok 9 months. It took Instagram 30 months, etc. Uber 70 months. So this is really fast adoption. So consumers are very into this in terms of testing it, figuring out what it can do for them. Businesses are also equally doing the same thing. The revenue being generated from these apps, sort of the dark green is Gen AI search. The apps are the lighter green. It's in the single-digit billions this year in terms of the revenue just derived from the app. As you can see, it's projected to grow fairly dramatically over the next 5 to 7 years. So we're talking a big industry pretty quickly. And that's all going to come at the expense of somebody else that's doing this kind of search, this type of application. So there's going to be losers as well. The foundational aspect of AI so far has been pretty clear. On the far left side of this page, you have to build the compute layer because these large language models that generate this type of artificial intelligence require enormous compute power, enormous as in something we've never seen before. So first you have to, you have semiconductor equipment like ASML, you have very complex design for advanced semiconductors for accelerated computing chips. That software comes from Cadence. Then you have, of course, the big guns who are making the chips like TSMC, and then, of course, the prima donnas of the group, NVIDIA, that design the semiconductors and are collecting 75% of the gross profit. Okay, so that's the food chain. Who's buying NVIDIA's GPUs? 48% of it is going to hyperscalers like Microsoft Azure, Google Cloud, Amazon's AWS, Meta as another hyperscaler. You could put Tesla and Apple in that bucket too. That's 48% of the demand. The rest is coming from large enterprises. So it's very concentrated demand. So so far it's been a good way to invest in AI, has not just been on the far left in terms of the supply chain, but also in the cloud-based compute platforms. The CEO of NVIDIA this last week was asked about return on investment for AI, and because it's a big hot topic in the industry now, is this for real, or are we going to make money on this, or is this a lot of money spent for nothing? And he said for every dollar that one of these hyperscalers gives to NVIDIA, it generates $5 of revenue for them on their cloud platform. So that's a big ROI. That's why you're seeing a boom in CapEx. On the software applications, we haven't seen much yet. Everyone's played with ChatGPT, that's great, but we haven't seen anything material. Microsoft Copilot is not that great yet. They're trying to monetize it. They need to improve it. ServiceNow, another big holding of ours, is starting to monetize applications for business process internally in businesses. It's just a process application layer that accelerates and reduce costs, reduce labor hours required to do certain tasks. That's already being monetized. So there's one. And then Apple, of course, has pivoted their entire franchise to Gen AI now because they want to turn your iPhone into your personal assistant using Gen AI. And they're partnering with OpenAI, which owns ChatGPT. So it's a pretty powerful combination. So so far, you're getting a little bit of activity here on the far right, but nothing to write home about. We'll see how it develops. what does the fourth era of computing mean? Well, the biggest impact is in semiconductors. This, you can see the evolution of the semiconductor industry over time. We just came off the mobile internet, and that's the sort of the orange section here. We're entering the blue. So by 2030, the chip industry will be $1 trillion industry globally. But all the incremental growth is going to be in AI, and it's already started. You're getting a CapEx boom in cloud-based computing. You can see it dipped a little in 2023. That's the hangover from the pandemic. Remember, they spent like crazy to boost cloud computing. We all needed it. Working from home, trying to keep our enterprises going. It took a lull, and then it's re-accelerating again. But and you can see, by the way, on this bar chart, it's hard to read, but those bottom four numbers are four companies. That's the only ones that matter. It's Google, Amazon, Microsoft, and Meta. They are almost 90% of all data center CapEx. So kind of everyone else doesn't really matter. But under the hood, there's a massive transformation. They're not spending on traditional data center. They're expending on accelerated computing. The best example of that is NVIDIA. This has never happened before in the history of mankind. In 2023, NVIDIA did $15 billion of revenue in the data center part of their business. It was a little under half their revenue. Last year, they did $48 billion. This year, they're going to do $110 billion. Their gross margins are 76%. Their operating margin is in the mid-60s. So think of 2/3 of that $110 billion is just dropping right to the bottom line, right to you as a shareholder. It's enormously profitable. So we've never seen in stock market history a company go from $15 billion in revenue to $110 billion in revenue in 2 years. It's not happened. So they're in the lead position. Their GPUs are necessary for accelerated computing, for training large language models and AI. Nobody can replace it. They won. They will have 80 to 85% of this market for the next 3 years. Now the question is, how far is that going to go? The data center installed base is $1 trillion. Over time, the CEO of NVIDIA believes the entire $1 trillion will transition to accelerated computing. So in that previous page where we showed a $220 billion of data center CapEx this year, think about that happening 5 times, but all converting to accelerated computing in the next 3 to 5 years. And in addition, the compute power is a lot bigger than just traditional data centers, so it's likely to be a higher number. It's very hard to model. Obviously, these are huge, huge numbers, and it may not come to fruition because the applications may be slow to develop, like autonomous driving. We've been talking about that with you for how long, and it's still not ready for prime time. That's one of the biggest Gen AI, probably visionary things out there, but it hasn't happened yet. So we have to be careful about what we're doing in the portfolios because we have a lot of CapEx going in. It's going to a handful of companies. It's coming from a handful of companies. But the one thing we know for sure is the profitability is extraordinarily high in this cluster. So if we look at why is the Magnificent Seven, why is it done so well? Well, here's the S&P 500 EBIT margins for tech and interactive media, that's internet, that's the top line. Over the last 20 years, it's gone up significantly. And then if you take the S&P 500 excluding tech and internet, EBIT margins are the same level they were 35 years ago. They've gone nowhere. In fact, for the average company, that's what you should expect. And so with profitability on a steady march upwardly, because the models are superior, they're scalable, they're global, they're low capital intensity, they're high return on invested capital type business models. You're getting exceptional growth in profits. And there's no reason this is just going to end. Now, somebody might get disrupted by AI, like Google might. So we need to be careful about that. They're not all going to win going forward, but this explains why you've seen the enormous march. The other important element of that profits expansion is it keeps a lid on valuation. So the stocks have done well, but the valuation actually is very reasonable. So here we're looking at what's happened at the prior peak of bubbles in different tech bubbles. So the real spiky hat is the new economy era, peaked in March of 2000. This is relative forward PE ratios, 6 times the market for the tech cluster. The next one down is the mainframe era in 1969, about 3 times the market average at the peak. The current is the little dotted line at the bottom. We're 1.6 times the market average for very good revenue growth and very good profitability. It's not in bubble territory like previous tech booms. So it's a very interesting dilemma in the market. You have this big boom going on. The leaders are driving the boom, but in fact, they're very profitable, generating a lot of free cash flow, so they're not expensive. Very perplexing for the market. It's having a hard time digesting this. Another way to look at this is sales growth. So the current sales growth prior 2 years is on the far right. It's low double-digit growth forecast for the next 2 years. Low double-digit growth, not that much different. Very different than the new economy era or even the pandemic, where in the new economy era you were forecasting 50% growth, and you ended up with 22. So that's why the stocks collapsed. They way missed expectation. You don't have that kind of expectation today. Same thing on valuation for the Magnificent Seven, as we talked about. It's not that demanding. The outside one is Tesla. It is demanding. We sold Tesla in January. As you know, we owned it for over a decade. It was it remains the number 2 contributor to excess return in the portfolio over the last 5 years. But we got rid of it because their margins are coming under pressure. It's very expensive. We don't think they're going to meet consensus expectations. Still forecasted strong growth. However, what we know about big growers, and it's not shown on this chart, but if you go back to 1950 and you look at large companies that grow very quickly in the preceding 5 years, what percent live up to expectation in the next 5? It turns out it's about 3 out of 7. So if we use history as a guide of the Magnificent Seven today as we're standing here, 3 out of the 7 will meet or exceed expectation in the next 5 years. 4 out of the 7 will disappoint and the stocks will do poorly. It's not good odds. So, again, it's been a great place to be, but one by one, you're gonna see them being sold out of the portfolio as we think expectations are too elevated for them. So that's going to be a transition, but that would be normal for history. The other thing is, if we look at CapEx, so the dark line, the peak is IBM at the peak of the mainframe era, accounted for 17% of the entire capital spending in the U.S. market. Not in technology, but all CapEx. Cisco, Lucent, Nortel, at the peak of the internet era, almost 15% of all capital spending in the United States was going to those 3 companies. Data center today is about 8, on its way, according to the consensus, to almost 14% in 2 years. So let's call that the peak. I mean, that's pretty much in line with those prior peaks. So, so the sort of summing all this up, you know, what do we think about what's happening at the infrastructure side of developing accelerated computing to power these large language models? We still are in the middle innings of the first part, but we're coming near the end. What's going to be the next phase of growth is going to be in the application layer. And that's going to be in parts of the market that we don't know anything about today. New companies are going to come public with very exciting verticals addressing this. So it's in some large companies are going to develop very cool productivity enhancing applications internally that we'll never see, but they'll be driving down costs. So there's lots of things that are going to happen, but we don't think necessarily it's going to be where the action's been the last couple years. Okay, quick review, and then we'll get into questions. So year to date, you know, up. This is through August, up 23.4%, excess return of 740 basis points. On top of, it's a really strong year on top of last year, which was a very strong year. What's driving it? Tech, number one, 420 basis points of alpha. Healthcare, 260 basis points of alpha. That's obesity. Okay. Financials, that's all fintech in emerging markets for us. What's quiet this year that's a big focus of ours over the long haul? Consumer. Consumer discretionary, 0. Consumer staples, slightly negative. It's very quiet. It's the one part of the portfolio that over the trailing 1 year has come down in exposure quarter by quarter by quarter as the lagged impact of all of this monetary tightening globally is taking its toll. There are very few companies left standing who are beating numbers in the consumer sector, and we're down to our last few that we're holding on to. Thankfully, we're about to start a new cycle because we're at the end of the misery, and we're about to enter easier monetary policy, lower credit costs. 25, 26 should be pretty good years for consumers. So we're not throwing in the towel. I'm just saying that's where the exposures come down, and that's where the performance has flatlined. Excess return. The big winners are on the left side. NVIDIA, 3.8% of alpha. That's half our alpha for the year. One company. It's up 130% year to date on the backs of those big numbers. But again, our weight has been coming down, and it continues to come down. We're restraining it. We're locking in that excess return because we don't know how sustainable that growth is going into 25, 26. We just don't know. The numbers are too big. The CapEx sensitivity is too high. We have good they're sold out. So it's very difficult to sell a stock of a company that's sold out. And it's not expensive. So we're just managing the risk in the portfolio. We still like it. It's gonna be the big winner long term, but we captured the big discovery phase of the company. The other cluster of AI is Broadcom and accelerated computing chips that are very specific for design purposes, and Arista Networks, all the data traffic controlling these data centers, very, very big for them. And then you see Apple. Okay, the rest is Mercado Libre and Nubank in Latin America, that fintech revolution I talked about. It's booming. And then, of course, Lilly and Novo Nordisk keeping us all skinny. Okay. The other thing about markets is it's been very U.S.-centric for 2 years globally. That's reflected in our developed North America is a big part of our alpha this year. And of course, that's tech and internet. I mean, that's where it's located. Emerging markets also huge. Very quiet in Europe, which again is a big part of our portfolio, but that's where all those big consumer brands are. That's where the direct-to-consumer models are. We love them, but demand has been slowing because of the global economy and because of China. And there's our top 10. So with that, I'll throw it open to questions.
A few slides back, you had your top 10 contributors and then your bottom 10.
Yeah, I never talk about the bottom 10.
How long did you hunt them before you actually got them up?
Good question. If it's a great franchise and it's just demand is slowed a little bit because, like Hermes, or Montclair or something like that, demand has not slowed for those two companies, but the valuations come down on fear because it did hit LVMH. That's more aspirational luxury. And so the valuations come down, but in fact, they're not missing numbers. They're still beating numbers. And it's double-digit growth, so we just hang on. We take the pain and hang on. If something is breaking down, as in they're missing numbers and demand is faltering, and there's no visibility to when it improves, we are exiting. So it really depends on what's driving the price performance.
NVIDIA's latest quarterly revenue was, I think, $30 billion. Apple produced 120 in the last full year, but they've got very similar market capitalizations. Can you see NVIDIA going up 3 or 4 times from this level? Not revenue, share price.
Share price. It can certainly double in the next 2 years, but the only way that can happen, well, one, they just have to keep the cadence of beating numbers, which is difficult at this at scale. It's very difficult at this size. And then the market has to, at some point, believe 2026 is going to be a strong double-digit growth year. If the market believes that, the stock can double because it's not expensive. It's mid-20s multiple. It's cheaper than L'Oreal. Okay? It's not. We're not talking, this is not heavy lifting on valuation, but the market, what is the market telling us at that valuation? That it just can't handicap it. The numbers are so big, the growth's been so quick that there has to be some digestion of all this CapEx and then let it sit for a while and then it will sitting for a while is not going to be good for the stock. So we have to be careful about that. That's why we've been bringing our position down, but we still own it. But it's tricky. But yeah, it can.
So Tesla's an interesting business model, especially when it comes to AI. If the valuations come down, would you reconsider?
Yeah, we never say no to anything. The problem with Tesla, 2 years ago, their gross margins were 30%. BMWs were 15%. Today, Tesla's gross margins are 17%, on its way to BMW. So they've lost their pricing power. They've had to cut price to move product. And so if I sit back and look at their EV franchise, which is 90% of their revenue, it's just an auto company. And by the way, their revenue growth isn't that great. So AI will have to be the driver to change the narrative. I'm a Tesla driver because we were a big shareholder. I'm a Tesla driver. I also bought full FSD beta, 13 grand, because I needed to track it and I had to write that check. And on a highway, getting off a highway, getting on a secondary road, it's great, especially when it's not congested. It works, but the minute you throw it into a confusing situation, it's very cautious. It's more cautious than we are, That's why it's safer. But caution doesn't work if you're just sitting there and you can't turn left and everyone's just blowing by you. It doesn't work. So I used to be a big believer in the Tesla software story that this would take off. But in fact, less than 15% of Tesla buyers, which I would argue were product forward people, tech forward people, bought autopilot, and less than 5% buy FSD, full self-driving. So as a consumer product, it's actually not popular. And so until it's popular, there is no autonomous driving story there. I don't believe it. And it may be there isn't really a good consumer use case for it. There's a good commercial use case for it. Like Uber would love to have autonomous driving because they could fire all the drivers who they don't like anyway. And that's a commercial application. But for you and I, we actually don't mind driving. I don't know. The consumer data just doesn't support betting the ranch on a software boom at Tesla. And say nothing about the Elon Musk factor that just gets more and more complicated every hour. So that's our view on that one. We're staying away for now.
Still talking about infrastructure. What is your view on when infrastructure will be regulated?
In the US, there will be none. In the EU, that's already underway. So when ChatGPT first came out, the first thing that happened was every tech company in the US pivoted R&D to Gen AI. How can we win from this? How can we do things with this? And the first thing the EU did was regulate it. So that's the nature of what's happening. So as you bring out services, it's a big question mark. Will Apple, say Apple becomes your personal assistant, will it be deployed in Europe? We don't know. It can't be deployed in China. So, by the way, we haven't talked about this, but China's going to sit out the fourth era of computing. It's going to be devastating to their growth aspirations. And the reason is the government cannot let Gen AI just develop in the private sector as it should, because they can't control it. So it's not going to happen. So they're going to sit it out. I mean, it's going to be autonomous driving for taxis and facial recognition for the government, and that's the end of the AI story in China. It's really bad. So I don't know what's going to happen on the regulatory front. It's going to be very piecemeal around the world. But in the U.S., there's not going to be any regulation for a long time. They're going to let it go until it does something bad, and then that's what they do. Yeah, exactly.
We'll now have a short comfort break. Please grab a cup of coffee and enjoy the short videos we have lined up for you.
Our mission statement is simple. It's about unlocking the green economy. And basically this is part and parcel of unlocking the green economy, basically looking at how renewable energy can play a core part into this whole green transition. Other people ask me about where does the name Imvelo comes from? Well, it comes from the Zulu word as Imvelo. I remember growing up, my parents always saying, you have to be in tune with nature. You have to be, in tune with the environment. So that's where we take our name from, Imvelo. It's about actually connecting with nature and the environment to do this kind of things.
Welcome to Karushoek, Ilanga 1 concentrated solar power project. Today we have traveled to an incredible location in the beautiful Northern Cape to see how Momentum Investments is building a greener, more efficient future for our country.
The Northern Cape, where we stand today, has got one of the best solar irradiation in the world. And this specific site is in an area called Karos. It's flat land, vast pieces of land. They're ideally suitable for this type of technology. This is what we call a thermal energy storage solution. It has inside it molten salts. So on the right-hand side, we store at 200 degrees Celsius, and on the other side is the hot tank at 400 degrees Celsius. So what do we do with it? It works like a battery because during the day, you're getting your solar field, producing the electricity from there. And part of the steam, we put it in here. This is your big battery. So, you know, there's this analogy that solar cannot run 24/7. The partners we work with, we've configured how we can do it. We can produce base load electricity. That is power around the clock. So this is our water treatment facility. The water comes from the Orange River. We pump it 11 kilometers, and then it comes here, it gets treated here, and then we got our dim water that actually then goes into the facility. It was about how you develop a project in such a way that you can improve the social fabric of the people living in all the areas that are actually surrounding Ilanga CSP1. At the heart of construction, there were 2,000 construction jobs here. The people living in the nearby communities built this with the international guys who brought in the technology. So part of the benefits of bringing something like this, it's creating the jobs of the future. And in addition to that, creating clean electricity, greener electricity, that is good for everybody's health because there's no pollutants. And at the same time, it's helping South Africa meet its climate change obligations around reducing its carbon dioxide emissions. I think, for me, this can be the mecca of renewables, creating new jobs, new industrialization for the better of everyone.
I am often in awe and humbled by the incredible country that we live in and by the wealth of beauty that we see around us, from the dramatic landscapes to the smiling faces on the people that live here. Taking this trip has once again impressed upon me the fact that we as corporate citizens have a duty to build a better world, to embrace projects like this and to help grow a sustainable tomorrow. Standing here in this fantastic space surrounded by such an amazing project, I'm once again reminded that we at Momentum Investments truly do live our mantra of doing well by doing good. Because with us, investing is truly personal.
To curate any exhibition requires comprehensive research, knowing your individual client's tastes, and understanding what shapes and drives their behavior.
Now that makes a pretty picture.
It's interesting. It's really bold.
I agree. The attention to detail is quite something.
You can see how much work went into it.
Somebody's going to be very happy to have this.
Curate is an independent global investment manager with a unique range of funds. Each one is managed by a team of highly skilled people that we have handpicked from top managers around the world to look after our investors' money. We curate each fund to meet a specific investor's need, and we have conducted thorough research to find the people that we believe are most suited to deliver on that. Ultimately, we believe that the art of investing lies in simplifying things. In a market where there are now thousands of different funds to choose from, we give investors a comprehensive range of options. This provides them with access to different strategies all in one place. It also gives them the comfort that each fund is being managed by a team that has been handpicked through a detailed research process.
We set the bar high so that we know we can trust those we select to look after our clients' money. Our research team has decades of experience, deep relationships across the industry, and a global view that means whether we are looking for managers in the US, Europe, South Africa, or anywhere else across the world, we hold them to the same high standards.
Our investors have reassurance that they don't need to search through thousands of different funds to find the reliable and trustworthy managers, because we've done that on their behalf. It's all part of giving investors access to the very best investment ideas. So why consider Curate as your investment manager of choice? Firstly, because we believe in having an investor-centered range of funds. Each of our funds is designed to meet a particular client need, such as saving for your future goals, growing wealth for your children and grandchildren, or ensuring that you have a balanced global portfolio.
We also believe in simplicity. We will always be transparent and keep things relevant so that you face as few surprises along your investment journey as possible.
We have a global reach. We research managers across the world to find the people we believe are most suited to delivering on what our investors require, wherever they may be.
And we believe that the best people have the highest standards. The people we handpick to be our long-term partners must offer something unique and show integrity, loyalty, and a record of delivering returns for our investors. Speak to us today or go to curateinvestments.com to find out more about Curate or the art of investing.
Next up on stage is the gentleman Mike Chen, head of Next Generation Research at Robeco. Mike's job, and correct me if I'm precise, is that of making sure that the next 20 years of quant investing don't look anything like the past 20. And he does so by employing a very smart bunch and looking at new technologies, new information, new data, to come up with very interesting alpha generative ideas for our strategies. So please welcome on stage Mike Chen.
Thanks, Lorenzo, for the introduction. Good morning, everybody. As Lorenzo mentioned, my name is Mike Chen, and I work for Robeco. I'm a quant, so I deal a lot with numbers. So speaking to people sometimes makes me a little bit uncomfortable with that. You have to excuse me. But I'll try my best. But, Robeco is a partner of Momentum. We're very happy to be here. And, we have a very core competency in quant. It's a very large group. I'm one of the members of the quant team up there on the upper left-hand side. But, the team is composed of many, many talented colleagues that I am very lucky to work with. And again, very happy that to be a partner on Momentum. And to meet you all, we're a sizable quant shop. We have 80 billion in quant asset, and we've been doing this for quite a while, actually, for about 20 years. And as Lorenzo mentioned, hopefully the next 20 years will be we're as successful as we were in the previous 20 years. And today I'm going to talk about something that maybe some of you guys are quite fascinated with. Obviously, everybody's heard a lot about AI, right? GPT is making daily news in the articles. NVIDIA, it's 3 trillion. There were about 1 trillion last year. It's a phenomenal growth. A lot of concerns about whether AI will replace humans. So I think there's a lot of hyperboles, obviously, right? But underneath all of that, there's actually a lot of changes I do personally believe will dramatically impact how we sort of live, work, and play, and obviously how we invest. And I'll talk a little bit about what's happening at the current moment. And, maybe if there's some time I can expand into what I think will happen in the future. And obviously, I would like to make this very conversational. So if you have any questions at all, please do, we can have a conversation. So let's kind of just set the scene a little bit, right? Why is this even possible? There's 3 secular trends that's profoundly changing our society. And these 3 and obviously next quant investing, These three trends are, one, the availability of data. There's just a huge amount of data available, right? And the fact that you get Google service for free is because you're providing a huge amount of data to Google. There's a survey that ran, actually, if you were to pay for Google, how much would that service be to you? And some people came out about $1,000 a year. So it's certainly a very valuable service. Think about $1,000 and how many users uses Google, which is at least half of the world, I would say, right? But you get it for free because every single search you ever did on Google is stored by Google to use for further analysis. Every single email you write on Gmail, some of you who uses Gmail, is stored somewhere. So, you ever had the experience like you write to your partner and like, oh yeah, I'm going to go pick up something at the store. And all of a sudden, ads start popping up, right? It's being read, right? So all that data is being captured. To be fair, a lot of it is just stored somewhere, right, in hope of being useful down the road. But a lot of it is still being analyzed and some by people like me in trying to make alpha, some by people at Google or Facebook trying to sell you the next best slice of bread, right? But it is there, so it's a huge amount of data for us quants. That's obviously very good news. In conjunction, there's a exponential growth in computing power. I'm sure all of us heard about Moore's law, right? Which is that computing power doubles roughly every 18 to 24 months, right? And it grows exponentially. And when you have exponential growth, it's something that's super powerful. I mean, exponential growth doesn't happen a lot in society, right? But when it does, it's something you should really pay attention to. Something very, very small at the moment can become extremely large, in very short amount of time because of exponential growth. And this is a chart of the sort of computing power, on a logarithmic scale. On the y-axis, that's logarithmic. So if you stretch it out to linear scale, it's exponential, right? And what's even more powerful is that this chart is based on GPU, and obviously, CPU. And obviously, we all know now there's this new computing structure called GPU, graphical processing unit. That's what NVIDIA makes, right? So if anything, this chart is actually kinking upwards. So it's actually growing super exponentially now. So that's super powerful. We have a lot of data. We have a lot of computing. And finally, there's a lot of super powerful algorithms that's becoming available, right? And obviously, the one we're talking about is AI. So AI is this very generic term that machines can think, right? And, if you asked me last year, do I think machines are sentient? I would say, no, that's science fiction. If you ask me now, do I think machines can be sentient? I said, yeah, probably about in the next 10 years, I would say. It can be sentient. OpenAI just put out a new model called Strawberry last week, right? And where machines can actually reason and solve, and it's called chain of thought reasoning. They can basically make each little steps and try to see each steps are correct and reason. And it can solve 90% of international math Olympiad problems, right? And this is last week. Again, couple this with exponential growth in power, try to extrapolate how much that can grow, is something pretty, I think something dramatic is coming down the pike, right? But let's get back to reality a little bit first before we talk about all that science fiction stuff or what might happen. At the present day, in quantum land, and certainly by Robeco, we use what's called machine learning, ML, and NLP, natural language processing. And I'll go a little bit into how we use ML and NLP, but these are sort of sub branches of AI that is currently being deployed at the moment by many quants, including Robeco. So why are we doing all this, right? And why are we spending a lot of time and effort? It is a lot of time and effort trying to do all of this stuff. Well, the reason is the market keeps on changing, right? The definition of alpha keeps on changing, and what you want to deliver to your clients to add value keeps on changing. Years ago, if you can just deliver equity market return, people think you're doing a great job, right? Well, obviously, index solution came out, and people say, well, if I can just buy an index, at basically zero cost, you got to deliver me something that's above and beyond that. A couple more decades later, factor investing came out, value, quality, momentum, right? And, that's great, but people say, okay, well, now, that's kind of being commoditized, and can you deliver me something a little bit differentiated on top of that? So you're always trying to push the frontier. And the latest is what we call uncorrelated alpha or next-gen alpha, where we try to utilize a combination of these alternative data, machine learning, and natural language processing techniques, trying to deliver returns that can be above and beyond what you can get from factor investing. That's kind of what we're doing. And what do I mean more specifically in terms of what we're working on? Well, so you have this is what I call the generations of quant investing, right? And I'm sure all of you guys are very familiar with factor investing, the value, quality, momentums, and those have been making a huge impact in the market and extract a lot of alpha for clients. But above and beyond that, because of change in technology, because of sort of diffusion of knowledge, you have to keep on pushing the frontier. And what we mean by next-gen alpha are 4 things. First, alternative data, just any kinds of data that's available. Factor investing is mostly based on financial statement information, so balance sheets and cash income statement. Here you can use tweets, you can use whatever people talked about, you can use their audio signature. I'll show you an example of that. You can use satellite photos, you can use the internet chat blocks, any and everything, right? And to process that, sometimes you need very sophisticated algorithms, so machine learning and natural language processing. And this being Robeco, obviously we'd be remiss not to say that we think you can actually extract alpha using sustainability motivated insights under certain circumstances. Not all circumstances, but if you align it correctly, you can actually extract alpha from sustainability. And I'll talk a little bit about that. That's kind of what we're talking about. So these 4 areas, and I'll show you examples of each. So I want to talk about 7 things about next-gen quant, right? First is that there's just a lot of data available, and I already mentioned that, right? But these data are rather, I would say, unconventional in the sense that, it's not always numerical. A lot of it is textual, some of it is audio, a lot of it is graphical, right? So you have to be able to process them correctly. And not only that, you have to actually, not only the variety, they actually come in with huge volume. Numerical data is actually very small, right? Something you can probably store on your computer, in memory. But some of these data really are truly large. They're in terabytes and exabyte sizes. So you have to basically store the whole computing architecture you need in order to process and store these data are different than what you used to be able to do. So you need to build up that. And even more, veracity is an issue, right? Not all data are actually truthful. We all know that fake news is a lot of that. So you need to be able to use truthful sources. So all that goes into consideration. And to do that, again, new skills and new technologies are required. And even more than that, right? Because there's so many data available, how do you know where to begin? Sometimes you give people too many choices, they actually choose to do nothing, right? Because they're overwhelmed. So what we do when it comes to data is actually still the same as before. We start with an economic hypothesis, something sensible, something like, in a sense, almost, doesn't take a genius to figure out, right? I'll give you an example. The example would be, if you want to invest in company, all else equal, you want to invest in companies with satisfied and motivated employees, talented, satisfied, motivated, right? Which is, versus the alternative in the US is a term called going postal. You don't want to have companies with employees that are about to go postal, right? So that's a very sensible hypothesis. Now, how do you gauge that, right? Well, it turns out that there's actually a lot of internet review sites. You can go and search to see whether a company's employees are happy or unhappy. If they're motivated or unmotivated, you can look at their resume to see if they have specific skills required for the certain industry that they're working in, right? So that information is then become useful for you to test your hypothesis. But you start with a basic fundamental idea. So what I'm trying to say is that just because there's a lot of data available, it doesn't mean that you should start with data, because then you'll never find anything. There's just too much to chase. You always start with sensible hypothesis. But the beauty of data is that now a lot of these hypotheses you can actually test and see if it works, right? Previously, you had no ways to verify if a company have good, happy, or satisfied employees versus those who that do not. But now you can. So I think this is what data is giving us, right? The ability to answer a lot more investment questions than we had before. Second thing is machine learning. And truth be told, machine learning is very hot right now, but it's not new. Actually, machine learning has been around for quite a while. It's right. It's been around. Theoretical machine learning has been around for at least 50, 60 years, and certainly I would say in finance, it's been used for 10 plus years. What's really different now is the computing that's available, right? So we can actually utilize and run the machine learning algorithm that's being developed, say in the 80s and 90s. And if you want, so what is machine learning, right? Machine learning is sort of a twist on the traditional computing paradigm. How many of the audience have learned programming before? Okay, some of you guys have learned programming. Okay, so the traditional programming paradigm is you have a programmer, obviously somebody like me, right, who have an idea of how you process data to get output, right? So what we do is we write a program, right? So you write a program that accesses the data and then do some computation on it, you get the output. What machine learning does, in a very simple term, is that it kind of twists this paradigm around a little bit. Machine learning says, I have data, I have certain output I can observe. I have no idea how do I get from data to output, right? But what I'm going to do is I'm going to put this program in here, this machine learning program, and then the program itself will figure out the relationship and tell me what's going on. So obviously you can see this is very powerful, right? When you have huge amounts of data, you just have no idea how A can be related to B, right? So machine learning is super useful in this sense, right? Obviously, this also comes with its challenges, and one of the challenges is that there's just a lot of degrees of freedom, in the sense that there's a lot of if you give it, say, find me a pattern that makes sense, it can find some really, really weird patterns, right? That only works in sample, but doesn't work in live out of sample example on data it hasn't seen before. So there are obviously safeguards that you need to put in. And me and my colleague Wei Li, we wrote a CFA book chapter that talks about all the various safeguards you need to put into machine learning. So if you like, I'm happy to send across that chapter. It's just some very basic guidelines, rule of thumbs that you should do. But with the right safeguards, you can actually find some very, very interesting patterns in machine learning. One of the things that it can find is what's called the interaction effect. Interaction is simply this. So you have, say, two features or two variables, right? A and B. Standalone, they kind of relates to your output in a certain way, right? But when you put A and B together, the behavior changes. So a very basic example is earnings, right? So if you have the higher earnings you have, the higher the return, stock return are likely to have, right? And it's very linear, let's say. But so that's variable A. But if you have variable B or feature B, say a red flag whether there's accounting fraud or not, right? When A and B are together, if there's accounting fraud, it doesn't really matter how high your earning is, right? The stock is going to go down, right? So that's a very basic example. So we thought about, well, can we actually discover more interaction and nonlinearity effects in our data? And we thought machine learning is the right way to do it rather than using humans, because A, it is just very hard for human to think in nonlinear terms, right? For us, we typically think in linear terms. And B is that we literally have thousands and thousands of variables, right? 1,000 by 1,000 is 1,000,000. There's no way that we can look at 1,000,000 combination in a reasonable amount of time and come up with sensible analysis, right? So what we do is we apply machine learning to this problem. In particular, we apply machine learning to what's called a reversal effect. Reversal, just to for everybody's information, is when the security price goes down a lot in a very short period of time. In the next period of time, it's very likely that it will go back up. Really, it reverts. Or if it goes up a lot, in the next period of time, it will likely go down. And we all seen this, right? Dead cat bounce, or something that trades really high and then gets and then crashes, right? And this is a very strong effect, and quants play this effect a lot. And here you can see the reversal, right? So the reversal is on the y-axis. You have return over the past 10 days. We ranked it from -3 to +3. +3 means that over the previous 10 days, return is very high. -3 means the other side, right? And the x-axis, we sorted by the news count. the volume of news associated with a given security. And when there's a very little news count, indicated by the -3, here again, everything is normalized, you see this reversal effect to be very, very prominent, right? So when the return over the past 10 days is very high, the average return over the next 10 days is -15. And when the return is very low, the average return is very high, right? So this is the typical reversal effect. But what happens is that when there's a huge amount of news that comes out, so you go here, +3, reversal effect completely disappears, right? And again, if you think about it for a second, you say, okay, well, that's obvious, because if there's a lot of news being written about a security, the price movement is justified, right? It's resettling into a new equilibrium. So, when NVIDIA comes out with, yeah, we grew our revenue by 100% over the last quarter, price moves up. Well, I mean, they're going to come back down. But again, like I mentioned earlier, imagine you're trying to do this over 1 million combinations, right? It's very, very difficult for people to look through 1 million combinations without missing something or getting tired or whatever. So this is something that you can discover using machine learning that, is not impossible, but much harder for humans to do, because humans do not scale very well. Right. Okay. Any questions so far? All good? Okay. Third thing is natural language processing. And as I mentioned earlier, natural language processing is a branch of AI. In fact, natural language processing is the technique people uses behind GPT and all of the latest generation AI models, right? GPT essentially is a autocomplete model on steroid. It's literally under the same fundamental technology. Your humble autocomplete in your iPhone that makes all kinds of mistakes. If you soup it up, train it on a billion and billion of samples, and with billions and billions of parameters in a model, it becomes a GPT, right? And people have been using GPT for quite a while. I'm sure you heard about sentiment analysis, right? People look at the words that executives say. Certain words are associated positively, certain words are associated negatively. And so executives obviously are not stupid people either, so they start learning to pick up the words, right? And us quants will say, okay, well, you kind of know my game, so I'm going to try to up my game to see something that, to analyze something that you don't actually pick up on yet. So it's a bit of an arms race. And the latest chapter of this arm race is audio. So we have done some work on audio. So we're not analyzing just the words anymore. We're analyzing how the words are being said. And I'll show you an example here. And by the way, so spoken words, apparently it's only 7% of the communication, right? And how it's being spoken is 38%, and body language is fully 55%. So if you can branch out this really narrow slice of communication, we think there's some value in there. So now I'll play you two examples. I want you to think of yourself as a portfolio manager, and you can only invest in these two companies, okay? So very artificial, but you can only invest in these two companies. And try not to judge your investment on what the executives say, but how they say it, okay? And final piece of information is that this is the second quarter of 2015. I know it's a while ago, but you try to transpose yourself to roughly 9 years ago, okay? And listen to these two executives. And then I'll run a poll, see which of the two company would you invest in.
Yeah, I would just say that certainly already having the right-of-way and the infrastructure in the areas, in a lot of our OVM area, we have a loop system, so we have one line that we can...
That's executive number one. 15-second clip, very short. This is executive number two.
All right, Ben, let me tackle the first one. Look, we don't give guidance, so here's what I will tell you. I will tell you that there are more buyers in the marketplace for hit content than there ever been in the past. So the way we look at...
Can I do maybe a quick poll? Who would invest with executive number one? There's a few up front. Okay, don't be shy. Executive number two? More executive number two, right? Okay, so actually the majority is right. Is executive number two. Executive number two is the CEO of Paramount Global. Paramount Studios, CBS, they own a lot of shows, they own a lot of movies. This is second quarter of 2015. If you recall, that's when streaming wars were going on really strongly. Netflix was spending billions and buying content. Amazon Prime is joining the game. You have Disney Plus about to launch, etc. Right? So Paramount Global CEO is like, we have this trove of content. If delivery mechanism is just a pipe, the value is in the content. I'm going to try to monetize this, right? Executive number one, on the other hand, is an oil and gas exploration company. And in the mid-2010s, the energy prices were pretty low. So he's like, yeah, I'm not super excited, but since we got to do this, otherwise I would not have a job. But, right? This is a gross simplification, obviously. This is very, vocal features are actually super sophisticated. Actually, unbeknownst to me, apparently it's one of the most sophisticated physiological phenomenon there is. But the principal component of vocal feature as it ties to emotion, right, is the frequency. So from physiology is that the more excited a person is, the faster he or she will speak, right? And clearly the frequency is higher in the second person than the first person, and that's the most obvious example. It's a little bit artificial. By the way, the stock of second security did go up way higher, and then the first one just kind of was in the doldrums. But it's a bit artificial example, this one, but it goes to show you that you can actually go beyond what's being said towards how the words are being said. I give you an example. Finally, I give you the fourth one is SI, and I'll switch up a little bit on SI. I already gave you an example of an SI alpha factor, right? Employee sentiment, right? And it actually is a deploy factor. We have a bunch of others, incentive alignment, fraud detection, resource efficiency that's related to, environmental aspects. But what about portfolio construction? Can you actually construct smart portfolios, right? And a typical way to construct sustainability portfolio is through restriction, right? You want to restrict your bench carbon to be 20% better than benchmark, 30%. Or, you only want to invest in company that's rated, say, rank B or higher according to some sort of SI measure, right? And that's perfectly fine approach. But we were thinking, is there a better way to construct sustainability portfolios, right? And what's really important about sustainability-minded portfolio is obviously sustainability. But let's not forget that return and risk are also important, right? Sustainability is really, really nice, but for a lot of people, the reason we invest is to provide a return for our clients, and that always needs to be there, right? i.e., the traditional investment question of risk versus return is really three-dimensional, right? You have risk, return, and sustainability. In this three-dimensional world, how do you build optimal portfolio, right? How do you optimally balance the three different aspects that you want? And if you think about it, the traditional two-dimensional world, risk and return, you have this what's called an efficient frontier. I'm sure all of you have heard of it. And the definition of efficient frontier is for a given amount of risk, this is the highest return. Given amount of return, this is the lowest amount of risk. So our question is, can you construct something similar, right, but in a three-dimensional world, right? So it turns out that you can. And we actually wrote a few papers showing you how to do so. But essentially, right, what you do is that we have a framework where you can build a portfolio in this three-dimensional world that for a given amount of sustainability, you have the maximum possible return and lowest possible risk. And if you want to increase sustainability a bit more, you have to either lower return and or increase your risk, right? It's called Pareto optimality. It's a bit geeky term, but it's an optimal portfolio. So we have this, and this is a technology that we pioneer, but we're happy to share with the world because we just kind of think this is something neat and important. So how does this factor into how do you do this, right? I just mentioned 4 different technologies that we're trying to push in the next gen front. Well, truth be told, this is not cheap. Robeco is spending 20 million euro per year on data as of last year, and this is a 2x growth versus three years ago. So we're spending 100% more on data than we did in 2020. So far, management is allowing us to get away with it. So we're very thankful for their trust. And our computing hour has gone up a lot, right? We're spending 35,000 hours on equivalent CPU hours per month to compute all this signals and do the portfolio construction. It's a 3x increase versus 3 years ago. But it's important. We think we need to do this because alpha decays, and we know this for a fact, and information gets arbitraged and knowledge diffuses. So we need to keep up, right? So we spend a lot of money on this stuff. But another thing that's important, and this is not talked about a lot, and but for me as a practitioner, I feel it's super important, is the infrastructure. I mentioned a little bit earlier the infrastructure. Infrastructure to me, it's kind of like the foundation of a house, right? It's not really usually seen, but if you don't have a good foundation, you can bet that that house is going to have problems down the road, right? The walls are going to start to slant. There's probably going to be some cracks, right? You can't really build a very tall skyscraper without a solid foundation. And I've worked at companies with good infrastructure, and I worked at companies with bad infrastructure. And having a good infrastructure is really, really paramount. And luckily, Robeco has spent quite a lot of effort and time in converting our infrastructure to the latest code stack with distributed computing, everything on the cloud, all that stuff. And I think actually at the end, if you have a good infrastructure, it's there's not really any trade-off, right? Good, fast, or cheap. It's a bit cheeky, I'm saying that. Actually, if you have good infrastructure, you actually get all three. Over the long term, it is actually cheaper to have ultimately the better infrastructure. But finally, it's still people, right? People are super important. There is this speech actually this gentleman gave. So this gentleman, his name is Richard Hemming, and he did some pretty fundamental work in coding theory, which is, again, it's another geeky field, but he was at Bell Labs, which is a very famous research lab. And he wrote that, things he looked for, right, in a researcher: curiosity, courage, drive, and scientific mind. He said, okay, curiosity, okay, I kind of get it. Drive, okay, I kind of get it. Scientific mind, of course. Courage? Like, what courage is there to just sit behind a desk and punch in the computer, right? Actually, people are uncomfortable doing this kind of stuff. People are kind of comfortable with doing stuff they know have done before. To do something different, or to go on a limb, and these are all very, our researchers are all very prideful people, right? And they've done well through their academic career, right? They've always been the top student. So to take a risk and fail, it's something that they're not necessarily comfortable with. And me as a leader of the team, or one of the leader of the team, really tries to say, okay, well, listen, we want you to take a risk, right? Because you can't just keep on evolving. Sometimes you have to take a leap, right? Evolution is good, but sometimes you also need a revolution, right? So that's a quality that I'm really trying to stress in my team. And I think it's actually the most important thing, right? Because all of this is just people, right? The technology you can acquire, the data you can buy, but what to do with it is still driven by the people. So it's a bit cliche to say people matters, but yeah, it actually does, and that's something that I'm really trying to stress. So that's kind of what I have to say about the Next Gen program, at least at Robeco. I don't know how much time I have. I'll leave it for maybe a bit of Q&A if anybody have comments.
I think you answered it in the previous slide, but is your increased spend in data then just about sustainability?
No, it's everything. Yeah, so sustainability obviously is a big part of it. So this is overall Robeco spend, right? Sustainability is obviously a big part of it, but we spend a lot of data on everything. So for example, textual data, we have, a huge corpus of news articles. We have all the filings. We have credit card basically transactions, anonymized, of course, various types.
So there's no marked difference in performance as a result of the increased spend then?
To sustainability?
Yeah.
So I'll answer that question in two ways, right? So sustainability, if you use it to change portfolio just pure for sustainability, it doesn't add to performance. The angle I try to take on my team with sustainability is for sustainable alpha, right? So I try to link sustainability with alpha. And under certain circumstances, you can do that. I have an article on how to do it. If you're interested, I can send it to you. And for those data that we buy and for those kind of research that we do, we have shown that it can actually drive performance. And actually what's really interesting is that a lot of sustainable alpha are very orthogonal to the more traditional VQM factors, right? So they actually complement it very well. And so it does drive performance. But if you just choose it for pure sustainability's sake, no.
Mike, you spoke about the decay of alpha.
Yeah.
How long or what's the typical development of you testing a hypothesis?
Mm-hmm.
believing that you've come to the right conclusion and then implementing, and then how long do you typically see that alpha opportunity last?
Yeah.
So really the life cycle of a hypothesis.
Depends. Yeah, so it depends. If something is kind of relatively known or relatively simple, it decays quick. I'll give you an example, right? So credit card, everybody heard about credit card data, right? Google search, I don't know if everybody's heard about Google search, but you can find Google, there's a thing called Google Trend. Google can tell you the search volume for a given topic, right? And some people have used it as an alpha. So that also kind of has decayed. These are all both signals I've done 10 years ago, right? So individually it has decayed, but actually when you combine it, that one actually still works, right? And you can use it to measure the efficiency of converting search into actual transactions. So how well, say, an advertising campaign for a given company works, right? So that still works. So some alpha decays quicker, some decays slower, all alpha decay, right? But yeah, it depends.
I just have a question on credibility of data.
Yeah.
And I mean, I think the irony is I read this on the internet somewhere, but I think Elon Musk was going to limit the time frame that he was going to use on his AI engine. Do you see that as a risk and maybe an advantage to creating alpha for your models?
I'm sorry, so what did Elon Musk say?
That he was not going to use internet information past a certain amount or certain date because of misinformation.
Yeah. So you definitely want to use data, but you also don't want to use the data you think could be fake, right, or untrustworthy, or very opinionated. Let's say, very unbalanced, right? So so you do have to curate your data sources, right? We tend to use data, for example, news article tends to use well-known sources like New York Times, Wall Street Journal, Financial Times, right? We wouldn't use, I don't know, some sort of tabloid type of information. But all else equal, I think more data is better than less data, because that means that your machine is capturing and understanding the world more. But it's a balance act, I would say.
Thank you. It's something I've been trying to understand, and there's a book called Nexus that tries to explain it. But your mind's like a muscle. In the past, we did math, and now we use Excel or a calculator. So we're using less of it.
Yeah.
So in the future, I think my direct question is, what's our alpha versus...
Good question. Great question. Fantastic question. This is a super good question. And actually something I want to ask the team, that's the room to think about, right? So Google, what did it do? And I used to work at Google, by the way. Google commoditized information, right? Information used to be very hard to reach and hard to get, and now it's commoditized. The way AI is going, I think it's going to commoditize intelligence. I think AI, if you ask me, I actually do believe AI will be sentient, which is, again, separate from this Terminator thing, which, a lot of things are sentient. It's not out to kill us, right? Dogs are sentient, but they're not out to kill us. Well, most dogs. So if intelligence is commoditized, what do you do as human beings, right? And to be honest with you, this is a real open question. I don't know. I'm on the parent board of my daughter's school in Boston, and I literally asked them this, like, what do you guys do as educators, right? Like, if how do you bring up the next generation, right? I think for me at least, I'll by the time that happens, I'll probably happy away rocking in my rocking chair somewhere, hopefully. But I think maybe creativity is still there, right? I think AI can solve math problem now. Even actually I know, but there's still certain rules and structures to math, right? I'm not sure if it can be creative. And I think another thing is empathy, right? Human empathy. And I think humans still, at least at this moment, right? Maybe the next generation is different. Still intuitively trust other humans more than a machine, right? So maybe this people-to-people bond, right? This empathy, this kind of human touch, so to speak, are still kind of our edge. But yeah, it's a great question. I don't know, actually. It's an evolving question. But I to be honest with you, I teach at MIT. I teach machine learning at MIT as my side hustle. Uber wouldn't take me. But I asked this question. Actually, a student asked me this question as well. My answer is the same. I think you just have to be. I think as machines become better at science, humans almost need to become more artsy and more liberal arts. I don't know if that makes sense, but I think you actually need to do something a bit different.
I suggest you all read I, Robot by Isaac Asimov. It was written in the 50s and is an amazing book about all of these. It's not like the movie, so there is no robots attacking humans or anything like that. It's great insight into how these things could evolve in time and what's the role of human beings going to be. His future was actually, interestingly, 2026, because it was written in the 50s. So now we're there. We're not there as he forecasted, but
still got 2 years
great
to go.
insight. That is true. And with the Moore's law, you never know. Exponential. Thanks very much, Mike Chen.
My name is Grégoire Chama. I'm a senior research and portfolio analyst here at Momentum. Our next speaker joins us from Jupiter Asset Management, where he is currently head of credit research and portfolio manager of the Jupiter Financials Contingent Capital Bond Fund, fund investing in European subordinated bank debt and one of the top performing strategies in the peer group since inception over 4 years ago. He joined Jupiter in 2013 as a credit analyst before taking on his role as head of credit research in 2019. Before joining Jupiter, he worked as a credit analyst at Moody's Investor Services as an associate credit analyst, and prior to this worked at Goldman Sachs as a financials credit analyst in the Southern European team. Please join me in welcoming Luca Evangelisti.
Good morning, everybody. Thank you for the introduction, Greg. So, as a brief intro as well, my focus, as mentioned by Greg, is primarily financial institutions, banks investing in general. So in today's presentation, I will focus mainly on 3 topics, which are related to financial credit. First of all, understanding the impact of digitalization. I will not speak much about AI, but more in general about what has been the impact of all these technological advances over the past decades. Secondly, I will focus on financials specifically, so what kind of instruments are issued by banks, and I will focus on additional tier 1 COCOs, so the riskier end of fixed income when it comes to banks investing. And I will finish with the opportunity, the investment opportunity, putting it in context of today's valuation to see what are the differences, if there is any opportunity based on current prices. So I will start. Before going into digitalization, I think it's important to make a very quick overview of the banking sector, where we are now. The banking sector, as you know, has been through tumultuous years after a global financial crisis. One of the probably more important indicators that we as analysts will look at is capital position of banks. As you can see on the right-hand side, basically, the capital of banks, so CET1 ratio or leverage ratio, has been effectively doubling even more from the lows of the global financial crisis to where we are now. We reached a sort of a peak already last year. Everything seems to be stabilized. As you can see on the left-hand side, also different banking sector, different banking systems have on average about 15% of CET1 ratio, which is a very high level. Given usually the minimum required by regulator is around 10% or even lower. So on a capital position, banks have improved substantially. Another is the asset quality, so the quality of the banking book, effectively the loan book of banks. And for sure, you remember during the Euro crisis, non-performing loans, so the kind of bad loans issued by banks reached really a peak, around 6.2% of the total. Also, under these metrics, almost every bank in every country in Europe and also in the US
have seen a strong decrease. So from the peak of 6.2% to now around 1.8, 1.9%. So again, also on the asset quality, we've seen stable improvement, which has led to higher profitability. The average ROE now on the left-hand side of European banks around 10.6%. There are some of them much higher than that. And I think it's interesting on the right-hand side, this summarizes in a way the cumulative net income of three banks that went into some sort of troubles, especially after the financial crisis. So UniCredit, Deutsche Bank, and the Monte dei Paschi di Siena, which, as you can see here, actually they had to raise around 70 billion euros after the crisis in order to make up all the losses that they went through. So really tough times, and then now back to profits, which are actually higher on a combined basis than the pre-crisis peak. Of course, helped by rising rate environment in the last few years. So also on the profitability side, we see strong improvements. But now, so how can we? What are the elements that we can try to understand whether or not digitalization had an impact on all of this? And there are not many metrics around it. So one of the key metrics that is used by the analyst community is efficiency ratio, which is a cost-income ratio. And in these slides goes back actually after the Second World War, and it shows the evolution of cost-income ratio for banks, going through very important milestones in the technological evolution. So from first credit cards to the introduction of home banking, internet banking, mobile banking, and most recently also AI. And I think there are two key considerations from these slides. If you see from the 1980s, when home banking was introduced, you see cost-income ratio actually was at the worst in a way, so very high, around 70%. And that came down substantially in the following 20 years to around 57%. But the second consideration, which is less obvious, is that from the early 2000s until now, actually the ratios remain the same, so around 57%. If anything, actually slightly higher. That's an interesting slide put together by the Autonomous Research. And actually, it deteriorated during period of crisis, and just only recently improved back to the levels that they used to be in the 2000s, thanks to the improved profitability that I showed before, which of course increased the denominator. So why? So the question is, why are we still at the same level? And there are, if you look at ways that banks can reduce this cost-income ratio, so try to lower the fixed cost, one classic way, the first that comes to mind is the reduction in bank branches, which are less useful as a result of all the kind of development and the spread of internet banking and mobile banking. On the right-hand side, so the slide is not very clear, but the average is 35%. So that's the reduction of branches in the last 15 years, from 2007 to 2022. And that seems to be a relatively high number of branches reduction. It varies across the board from the most digital focused banks on the left-hand side, including BAWAG, NatWest Group, for instance, to the least one. In average, 35%, it seems a lot, but it's actually not that much. The analyst expectations were much higher than that, was close to 70, 80%, so we're still far away from there. And the proof of that is that if you look at, on the left-hand side, that shows the more anecdotal evidence in countries like France, for instance, Germany, Italy, so very large banking systems. Actually, the number of banks branches still exceeds the number of petrol stations, for instance, or even post offices, which is somewhat counterintuitive given the strong development of home banking and mobile banking. So there is still, again, work to be done. Some banks have done it, but many that still have cost to save through this. Another indicator, in a way, of how digital has helped banks to reduce costs is the headcount reduction. So obviously, processes are more automated. You need less people in branches. You need even less people in the head offices. So on the left-hand side here, I'm showing how the headcount in the domestic banking system, or different domestic banking system, has evolved. You can see actually quite a strong reduction in some countries like Germany, France. But if we focus mostly on the last, let's say, 7, 8 years, you see that only the UK, for instance, managed to reduce by 4.1% the headcount as a banking system,
But other countries like Canada, Sweden, or even the US actually saw an increase in that. So again, also in this perspective, there is more cost savings to be done and better synergies to be achieved. But so why, despite there has been some cost savings, some banks actually reduced branches, on average 35, headcount reduction on average happened around 20%, but still the cost income, the cost, especially the numerator, is still relatively high. One of the reasons is that with the rise of digitalization and digital banking also, we've seen an exponential rise in cyber attacks, and especially in the financial sector, as you can see in the left-hand slide. With that, obviously, there are costs associated to deal with the aftermath of the attacks. So there's a financial implication, and also for preventing attacks, banks are spending more and more in cybersecurity prevention, and their budget is increasing in every continent, actually. So that obviously increases the cost base, resulting in total spending for IT-related services, including cybersecurities and technology at firm, rising, basically to a level which is around 10% of banking revenues, or also around 12 to 15% of total cost. So that's one of the reasons why it's hard for now to keep efficiency ratio in check and continue those improvements that we've seen from the 80s to the early 2000s. I mentioned cybersecurity. I think one interesting development this year has been from the regulator, from the ECB. So the ECB usually conducts stress tests on the balance sheet of banks, on the capital position. They impose capital requirement. For the first time this year, actually, they are looking at the cybersecurity, at the cyber risk, and they conduct a cyber stress test, looking at what would be the consequence, how banks deal with a successful cyber attack. The good news for the banks in a way is that the ECB is not imposing any capital requirement as a result of that. But my personal opinion is that we will get there, and this probably will result in additional costs and additional capital requirements. So less ability to lend to the real economy, but more capital inside the banks, which for fixed income investors is not a bad thing. But again, it will not improve the cost picture of the banks. Just to summarize this first part, is important. I mean, I'm a credit investor, but also looking at the equity side, looking at banks' equity performance and the differences in valuation, analysts have noticed that there is actually no much premium for those banks that are digital leaders compared to the laggards. The only positive comes from the expectations that the jaws, so the rate at which revenues will increase compared to cost, is positive for those banks more advanced technologically. But apart from that, again, there is more valuation premium in the current valuation today. On a credit perspective, actually, it's even less than that. You really cannot see any differences, even if you pick the top, the banks that reduce the most branches or are more automated compared to the least one. The differences in credit spreads, and we'll get through that later, are really minimal. So again, it's really not impactful at the moment on fixed income investments. And again, as I mentioned, cyber risk is becoming more an area of concern and very important for financial stability. I'm introducing the next section, just summarizing here, moving to the valuation side also, what's the performance of banks' equity. This is in the dark blue line compared to banks' credit, simplified by Tier 2, so the fixed income instrument, subordinated instrument issued by banks over the last 20 years, which is a bit counterintuitive. You would expect banks' equity to perform better because equity is actually riskier than fixed income. But apart from the initial stages before GFC, actually we've seen a very divergent performance. Only recently, due to rising rates and higher profitability, banks' equity is catching up to some extent to banks' credit, which nonetheless perform much better. So this brings me to banks' credit, to financials credit, which is an interesting area. Many people think there is more of a specialist area, and it is in a way. But it's important to notice that about a third of total corporate debt, so not considering government bonds, but just corporate bonds, is represented by debt issued by financial institutions. It varies in Europe. It varies by countries, 34% in euro, 45% in sterling, and less in dollars, 28%. So it's a big part of the market. And COCOS, which is going to be COCOS or additional Tier 1, which is the same thing, represent a smaller portion of this, so about 2%, 4%, and 1%, but still in aggregate around $250, $260 billion now. So it's still a relatively large market, despite being much smaller than the overall financials. So what are COGOs? What are the instruments issued by banks? And here I don't want to go through all the different characteristics, but in a nutshell, additional tier 1 COGOs are effectively, as I said before, the most subordinated fixed income instrument, very close to equity in a way, because they are perpetual, but also close and more similar to bonds, because effectively they are bonds, and they are callable every 5 years, 7 years, or 10 years. So the banks issuing it can decide to retire it. And based on recent history and the history actually of this asset class, that's effectively almost always been the case. So in this case, they're very much like a fixed income instrument. The key characteristic of COCOs, which I'll come to that also later, is that they're considered going concern instruments. So they are issued and they're being conceived with the idea that banks can use them in case of trouble. So before going into a default, before going to resolution, those instruments are supposed to take losses and to help the banks to recapitalize and go ahead. So they're considered going concern instruments. In reality, and I'll come to that later, is not what we've seen in the market, which creates, in a way, a valuation mismatch. In a more simple way, in a more kind of a graphic way, that's where they sit. Sorry, the slide is not super clear, but in the circle area there, that's a capital structure of banks going from equity all the way up to senior or even covered bonds in order of seniority. And as I said, they sit just above equity, but below tier 2, below standard senior debt. And one of the more interesting characteristics is also the way the coupon works. So let's say an additional tier 1, a COGO is issued at 7% in a period where interest rates in the market are, let's say, low at 1%, so with a 600 basis point initial spread. Now, this initial spread remains the same through the life of the bond, despite the fact that the bond can be called or not. If it's called, of course, it's retired. Banks need to issue a new one. If it's not called, the coupon is recalculated, considering the now prevailing interest rates, could be 2%, 3%, or 4%, or lower, of course, resulting in a higher coupon in a rising rate environment, which has been the case over the past few years. It's still the case, even if rates start to come down. Probably we'll see today with the Fed as well. But nonetheless, banks are now still refinancing bonds issued many years ago with a much lower coupon into bonds that actually have a higher coupon, which still keeps a very good valuation in the sector and very high carry in terms of income produced by these securities. This is in a way, I don't want to go into the details, but one of the risks of these securities is the capital trigger. So they're considered going concern because theoretically, if the capital of a bank, which is that the first chart I showed you, which in average is 15%, if it drops below, let's say 7%, which is a common trigger level, the COGOs are converted into equity, the very diluted price, or written down. So it's a really almost total loss event, which is effectively what happened with Credit Suisse last year, although with some technical differences there. This risk is very remote. In the example I brought here, I'm showing Nationwide, which is a building society here in the UK, which has a 27% CET1 ratio, even under really stressed conditions. So applying also our own internal stress test that we do on top of the one that the regulator does. The buffer still remain, it's 7.7 billion now, it's 7.1 billion after stress. So just to show that this is clearly a virtuous example, but many banks are in a position where the buffer are so large that, yes, the losses needs to be really, really extreme to get even closer to that level, which makes these instruments, again, more of a gone concern instrument rather than, at that point, at the 7% capital point, banks are usually already in default, already gone. So again, another argument to show you that this is really more of a gone concern or like a normal subordinated debt. The point I wanted to make in this slide is simply the dark line at the bottom is the share price of Credit Suisse, and the share price of Credit Suisse in the last year, effectively, of the life of this institution, going basically from almost a little bit above par, let's say a little bit above 100 to 0. And the other two lines at the top are, three lines actually, are
Caucasus, so additional tier 1 bonds issued by Credit Suisse in the past. And what happened here, which again proves my point of being a going concern instrument, is that Credit Suisse decided actually not to use the discretionality they had on the coupon. Any bank can decide to switch off the coupon of these bonds, right, in case of difficulties. But in reality, there is no bank in the history of this asset class that ever decided to switch off the coupon discretionarily, so to avoid the stigma associated with it. So what happened with the gray line that you see at the top is that there was a bond coming up to refinance in June 2022. The bank was already going under stress. In a way, the share price was already down more than 30% in the year. The bank actually decided to refinance it, so to pay par back to the investors and issue a new one with the coupon going up in price from 7.18% to 9.75%, so paying up more than 2 points to the investors. Again, that's happened, continued. The price, as you can see, remained very stable, close to par, until the point, obviously, when it was effectively bought, rescued, so to speak, by UBS. And based on the decision of the Swiss authority, these instruments were written down to zero, as you would expect in a resolution scenario, in a pre-resolution scenario. So again, proving the point that all this discretionality, all these triggers actually are redundant where the banking system is now, but this act actually only as a going concern, despite paying very high coupon. As you can see, it was paying 9.75%, and most banks now are paying high single-digit coupon to the investors. So moving to the third part, is there any opportunity in subordinated debt? So subordinated debt issued by banks, first of all, let's look at default risk, especially with all this talk and discussion in the analyst community about whether or not we're going to slow down. There is discussion whether or not we're entering into recession potentially in the US. This is the default forecast on the left-hand side of major industries by Moody's. This is 1 year default rate forecast. Banking is at the top in the sense that in Europe is expected, the default rate is expected to be 0.4%, in the US 0.1%, which is more comparable to utilities or very low-risk sectors such as the electrics or water companies, or other sectors, obviously not cyclical, which are expected to a much higher default rate, varying from 2 to even 5 or even 6% for construction and building. So again, this is just the forecast, of course. There could be differences banks by banks, and of course, the situation like Credit Suisse can always happen. But at the moment, this is the expectation, and default rates and the defaults in the banking sector are very low. So comparing, this is a slide that I show almost every presentation, and it ranks effectively all fixed income instruments, all sectors that you can invest in the fixed income world. So starting from AAA bonds at the very bottom left, yielding really small spread compared to government bonds, all the way to CCC corporate bonds, which are defaulted companies. They yield a lot, but they're almost defaulted, and their default risk is super high. So COCOs are the second, effectively the last on the right, the second last from the right, at around now around probably 7% yield, which is very interesting if we compare with corporates, for instance. So corporate bonds and non-financials rated single B, so very low in a way, so with relatively high default risk, they yield less than COCOs at the moment, so 6.3%. And you may wonder, okay, but COCOs are more risky, but if you look into the composition, so this is at index level on the right-hand side, so you have COCOs index broken down by ratings. So what type of ratings are the instruments in this index compared to the high yield corporates? And you see that actually in the COCO index you have a quarter that are triple B, so investment grade rated. The rest is actually double B, which is a good sub-investment grade rating. Whereas high yield at index level again is there are double Bs, but there are also single Bs and below. So on average, lower rating compared to COCOs, which is double B plus on average. And again, COCOs at the moment offer a higher yield. Just a couple more slides on valuations. And so I talk about yield, the previous slide. This is spread, so kind of the risk premium given by the specific institution that you invest in. And again, on the left-hand side, you see the black line is the spread offered by COCOs compared to Tier 2 and Senior, which are these other type of debt issued by banks. You can see again, despite the strong tightening from COVID times and from Credit Suisse times last year, still you see a big gap from additional tier 1 here and tier 2, for instance, and senior. Again, denoting a perception of the market of a much higher riskiness of this asset class compared to tier 2, which ultimately, tier 2 is also an instrument that can take losses, of course, in case of defaults, and it's not secured the same way they're not secured AT1s. And then moving to non-financial, so comparing AT1 to non-financial corporates. So you have, again, the spread of additional tier 1 around the high 300 basis point versus double B corporates in the US, which has surprisingly tightened substantially, despite also the situation in the economy. And again, showing a gap which is almost 100 basis point, which again we think is excessive, and it should narrow down in terms of COGOS narrowing down towards the double B companies. And lastly, you might know also there are COGOS are issued by European banks. US banks, they issue preferred shares, which are very similar to COGOS. The only difference is that there is no explicit trigger for write down. But as I said before, the trigger is quite redundant because the bank will be already defaulted by the time they reach a trigger. So that makes very similar the instruments. They're both discretionary in terms of coupons, but they trade, again, due to perception, trade in a very different way. And again, you see still a very high spread for COGOS, the orange line, compared to pref security, which tightened substantially. So that's in a nutshell. Just give you an overview of how we see the world in terms of countries that we invested in our fund very briefly. And we maintain a very still positive view on the UK and also in some peripheral countries. The UK, due to the low risk, also the valuation still reflects some uncertainty and some concern about the housing market and the mortgage market, which actually we don't think they're funded. So we are quite, also the example I mentioned before about Nationwide, with the stress test we do in our part of the day-to-day job, we are very confident about the resilience of UK banks at the moment. We also like Spanish banks, both the top banks and also the smaller banks, so the kind of middle-sized banks. In Italy, France, we are underweight compared to benchmark and peers. We like less the political situation and the fiscal situation. And in Italy, we like mostly the two large champions, so the Unicredit and Intesa. Whereas in Germany, also we have a strong underweight, as we are quite concerned, apart from one or two institutions, we're quite concerned about the economic landscape and the potential effect still of the commercial real estate market. Just to conclude, basically my key takeaways of the presentation. So the first part, I would say my conclusion is that digitalization is not has not a strong impact so far on banks' fundamental. We've seen a lot of improvements, but not due to that. It can change. There is still room for improvement for many banks, but at the moment we're not seeing that much into the numbers. Secondly, on financial credits, it's probably an underinvested part of the market, and I think it still provides lots of opportunities due to this misconception of risk of the instrument, especially in the COGOS space. And valuation-wise, again, COGOS, I think the most striking thing is, again, the comparison with high-yield corporates, which sometimes are perceived as safer, but in reality, they are lower rated and lower yieldier than standard COGOS bonds. So I'll stop here. I'm not sure how have I done with time, but I'm sure there is time for questions.
Luca, this is a very specific subsection of the market. What can an investor expect as a return from this asset class? What should our reference be?
Yeah. Okay. So I'll tell you the return year to date has been relatively good. So in the first 8 to 9 months of the year has been around 10%. I think it varies. Obviously, last year was a very particular year due to Credit Suisse, so returns were skewed at index level by Credit Suisse. But normally, if you think that the average coupon now issued by COGOS subordinated debt is probably around 7-8%, so that's a carry that you would expect. If you believe in what I mentioned before about the potential for compression in spread, that can add more, of course, in terms of price appreciation. So at the beginning of this year, I was guiding guiding investors for a 10% plus year, and we're already there, and there are still 3 months to go. Probably I wouldn't say the same for next year. I wouldn't say there is a
10% plus year next year because spreads are already more compressed. But the way the coupons are and the spreads are is still high single digit kind of a returns expectation for in a normal year, I would say.
Luca, thank you for that. There's a new generation of digital and disruptor banks waiting sort of in the private wings. As they sort of mature and come to market, will they be joining this party or disrupting it?
Yeah, look, it's a good point. There are many fintechs that are just now entering the market and trying to compete with banks. On a fixed income perspective, we haven't seen much because the size of these banks is still too small to actually issue this kind of instrument. So the average size, for instance, of in the COCO market is between $500 million to $1 billion in terms of size of instruments every time they issue a COCO. So it's really large, and so usually only very established, very large financial institution can access this market. The fintech are trying to now, they're usually funded also by the private credit or mostly by private equity, of course. So they're trying to compete, and they are indeed competing in certain businesses of the large banks. But yeah, on an instrument perspective, I don't think we'll see any issuance from these kind of companies probably in the next few years until they become really big. But on a business perspective, yes, they're creating noise, they're creating competition with banks, but they don't have the scale yet to really affect the large customer base and the many revenue lines that the banks have.
Well, that brings day one of Virtual Think Tank to a close. What a great lineup of speakers we've had to kick things off. Andrew Hardy, Managing Director of Momentum Global Investment Management, opened up the conference with a warm welcome to our delegates and reminded us of how far we've come as a business since our inception in 1998, with nearly $9 billion of assets under management and $22 billion of assets under advice. And after being signatories to the UN's PRI since 2006, we also this year became signatories to the Stewardship Code in the UK. Andrew set the scene for the theme of the conference this year, investing through the fourth industrial revolution. Ravi Balakrishnan from JP Morgan laid out the economic backdrop facing investors at the current time. And whilst they don't rule out an economic contraction, the base case is for a softer landing in the US and the rest of the world. Yes, employment numbers in the US have been slowing, but most data point to a continuing of the current state of play, with little imminent risk to consumers or corporates. The US continues to lead the world, with Europe facing structural and regulatory headwinds, and China still reeling from the collapse of the property sector there. And could the UK finally be turning its corner? We hope so. All eyes now fall on the looming US election and what that could mean for global trade and growth. We then had our first external manager of the day, Mark Baribeau from Jennison Associates. And what a great way to kick things off in global growth equities, which continue to dominate the market, headlines and returns. It's always great to hear Mark talk and learn about new and emerging trends in investment. Not necessarily what's hot today, but what's hot tomorrow. Mike Chen from Robeco spoke to us about the applications of AI to investing and factor investing more specifically. Momentum has a long partnership with Robeco in equity factor investing, and it was great to hear about the future direction of quant investing. I think the message was clear that the machines won't replace us humans, but we need to evolve our working practices with them to harness the best technology we can offer. If anything, humans are likely to retain their creativity crown for the near future. Luca Evangelisti from Jupiter then talked us through how financial institutions have used technology to improve their businesses and profitability, and how tech is now being deployed in cybersecurity, software, and innovation. Luca's speciality is in financial credits, and he presented to us the opportunities available in financial credit today, notably in subordinated financial debt. Bank balance sheets are much stronger than the GFC era and make an attractive risk-adjusted return today. So that is it from me, other than to say if you'd like to receive continuous professional development points, CPD, please watch the full session and ensure your ID number is logged in the CPD section so we can verify your attendance. You can revisit this session anytime until the end of November and can still earn CPD points. We have now automated the sending of CPD certificates, and they'll be emailed to you as soon as you've finished watching the full session. Thank you for joining us again today. We look forward to seeing you in the next session again tomorrow.